Hello guys, Trader here. Today I will be showcasing some of the strategies I use in day trading the cryptocurrency markets. I would consider myself as a swing trader on the intraday, where most of my trades happen on the lower time frames. My approach to the market is that I'm always trying to have an open mind or an open discussion where I'm asking the market a lot of questions and I'm trying to dissect the answers that it's providing me in terms of the price action and the more psychological patterns in the market. It's important to understand that even manipulated markets have some sort of structure to them, and even so are acting in a more natural way than less manipulated markets. We're going to talk a lot about technical analysis and price action patterns and just patterns in general, and also how we can use them in conjunction with the indicators, but I just want to make it very clear from the beginning that technical analysis on its own without understanding market psychology or market dynamics is absolutely useless. Now, what I mean by this is, so let's just make it extra clear. So let's just make, just for show here, some sort of example. So let's pretend that we have this falling wedge pattern here in the small uptrend, and we also have some sort of bullish D1 divergence on the RSI like this. And people are going to say that, oh, we have bullish divergence on the RSI on the D1 in conjunction with this falling wedge pattern. It's a safe trade to take. Yet I hear many people, they use different kinds of patterns, different kind of technical analysis. They have their own pattern that they are trusting or using. Maybe they have some moving average, pivot points, Ichimoku clouds, volume, order flow, whatever, you can name it all. I've studied everything that there is to know in technical analysis way. I know all of these patterns in the market, and let me tell you that they do not work. Even in conjunction with indicators, they still do not have a higher strike rate of playing out in the quote-unquote right direction more than 50% of the time. So let's pretend that we have the data, we have journaled every pattern in the market, and we have every possible data for the Bitcoin charts on every falling wedge in conjunction with daily bullish divergence on the RSI, and it says that it has a 49.9% strike rate. Would you take this trade? Would you take this trade in the market? Of course, this is just an example, but I'm just trying to prove my point here that most of these things in the market, and when I say most, I mean 95%, even when everything lines up, you're still pushing the 50% mark of something playing out in the market. TA on its own, or in conjunction with multiple patterns, is useless. If it doesn't have a proven data of, higher than 50% strike rate, why would you ever take that trade? I see a lot of people, they have spent thousands of hours, just like me, trying to understand technical analysis. They've read every book there is, they know everything about Fibonacci's, every pattern, every candlestick pattern, every indicator. Alright, they know about volume, order flow, and all of that. Yet we're still just trying to catch the 50% mark. And that's why almost everyone who day trades lose money. 90% of people lose money day trading. And it's because, they may watch some video of some technical analysis, watch some guy on YouTube, or read some book by some Wall Street guy. Use this pattern. We're looking at this pattern and this indicator, and it's gonna work, guys. It does not work, okay? I've spent the last couple of years in the crypto markets tracking data on all patterns, journaling every trade I make, and back testing some of these things, and it does not work. And when I say it doesn't work, I mean it has a less than 50% chance of playing out. Sometimes everything lines up perfectly, and only then we can start pushing this number above the 50% mark, but for the most part, it's very rare that everything lines up in the market. It's extremely rare. So let's pretend that we have some spectrum here, where we have 100 here, we have 50 here, and we have 0 here. Okay, so in this space or in this area here, we have some sort of all-knowing understanding of the markets, and over here we know nothing. And what makes up this scale is patterns, indicators, and also market psychology and market dynamics. Okay, so let's say that you are just trading technical analysis, you're using patterns, you're using supply and demand zones, resistance levels, indicators. Okay, only then you're only trying, even though you know all of these things, you're just trying to catch the 50% chance of something playing out in the market. Sometimes when everything lines up, you can start pushing this number a bit higher, but for the most part, you're looking in this range here. Yes, some of these things play out. You know, I see a lot of people trading the more popular patterns, such as cup and handles, head and shoulder patterns. There's a couple of hundred of those patterns out there. You have to realize that these patterns have been around since the early 1900s, and guys, it's not that easy. They do not work. And you know, I see a lot of traders, they're posting their charts saying, oh, we have this pattern here, we have this indicator saying this and that. If you don't understand the market, if you don't understand the psychology behind the market, you know, all these candles and wicks here have some sort of deeper psychological meaning. And it's our jobs as day traders to be able to dissect this. We have to understand how all the participants in the market think, how the CM is operating in the market, how the CM is making decisions, and we want to follow the CM. And we want to, of course, we can't play as the CM, but we can identify what the CM is doing in the market. And when he is done, we can start eating as well. When everything has played out, then we see retails and specs and funds entering the market. And yes, these things do play out, but for the most part, it's useless and it doesn't work. So in this video, we're gonna talk about psychological patterns and market dynamics. And we're gonna look at some of these things, you know, how to identify liquidity pools, how to identify institutional supply and demand zones, how we can use, you know, higher time frame bias or some sort of higher time frame directional bias that can support our lower time frame swing trades. And we can use everything in conjunction, and we can start looking on the right side of the 50% mark. And you know, just because something works on Bitcoin, you have a proven strike rate of some patterns working on Bitcoin, you can't just start applying them to every other mid and large cap. Oh, this pattern works on Bitcoin, it has to work on Ethereum too. No, you have to study the Ethereum market and understand the character of that particular market, because every market has their own character, and it takes a long time to collect the data and journal your trades and journal patterns, journal indicators to see what's actually going on. Otherwise, you're constantly playing catch up with the 50% chance of something happening in the market. And sometimes they do play out, and that's the part of the game, because if it didn't play out, no one would be using them. Okay, so let's say that falling wedge patterns play out 40% of the times on their own. Is that a trade you want to take? Of course not, because you're gonna lose your money in the end. Okay, the market is quote unquote rigged, and these patterns have been around for a long time, and they're used as cannon fodders for the CM to collect all of the specs and funds and retail traders dumb money. That's all they're used for. Technical analysis is a way to trick people. Only when we understand market dynamics and market psychology, we can actually start using these patterns in the market. So that's why in the beginning of things, we're going to lay out some sort of structural basis and how to draw levels and how to draw supply and demand zones, how to draw them on high time frames, how to draw them on lower time frames, how to use all of these things in conjunction with the lower time frames to gain some sort of directional bias on our lower time frame swing trades. And in the end, we're going to look at some of the more technical side, how to use some of these indicators in conjunction with patterns, and then those things, technical analysis based things, how to use those things in conjunction with market psychology. And only then we can start looking at 60%, 70% strike rates of these things playing out. Of course, nothing is risk-free. I'm not here to tell you that there is some risk-free way of making money. There is no risk-free way. You know, if I have a strike rate of something playing out 60% of the time, that's golden. This is gold. If you have found a way to trade the markets where you have a strike rate on your strategy that is gonna work out 60% of the time, you're gold. You're literally gold, and you're now worth a lot of money to a lot of people. But technical analysis on its own, it's useless. It's completely useless. Alright, so in the beginning here, we're just gonna go through my workflow, and as the video goes on, we're gonna start looking more and more on these more psychological patterns in the market, and you start looking at what's actually going on in the market, because there's nothing random about this. And TA is not gonna help you solve, what's actually happening in the market. Okay. So, in the beginning here, keep it very basic, and there's gonna be a lot of topics in this video, so I can by no means have time to go through everything in depth, but this is just to show you, and this video will act as some sort of introductory video where I showcase some of these things. And I will by no means have time to go through everything in depth, because there simply is way too many things. Okay? So I'll pause the video here, and we're gonna go back and we're gonna redo everything from scratch. And as the video goes on, we're gonna go more and more in depth. Just quickly before we move on, I realize that there is gonna be a lot of people that are gonna say that, well, if something has a proven data of not playing out, so let's say that we have data on all of the falling wedges in the Bitcoin market, and they only play out 48% of the time, there's gonna be a 52% chance that it's not gonna play out in the right direction, right? So why wouldn't I just counter trend these things? Well, because it's not really that simple, because sometimes, let's say that we have a falling wedge like this, and the price is approaching this lower icing here. Sometimes we see something like this, and that's why I can't really counter trend this, because there is only this much for me to make. So some people would say that, well, this falling wedge did play out. Well, it didn't really play out. It failed, and we dipped in this pool here under this icing, and then we moved up. I wouldn't count that as a falling wedge. I wouldn't count that as like a natural falling wedge pattern. There is something else going on here that we need to solve in the market. Alright? Now that's what I mean when I say that these things doesn't work. Well, some people could argue that yes, it did work. We just had this small falling out here. But in my opinion, I would say that this isn't really a falling wedge pattern, because there is something else here that's very important that's going on here in the market. Okay? So I just want to make that quick disclaimer, because there's always that one guy who's trying to be really smart about things, and he's gonna come in here and he's gonna start questioning like, oh, you're so smart, why aren't you counter trending everything? It's not that simple. I just want to make that clear, because there's always that one guy. Okay, so now that we've talked about that, I know I bash a lot on TA, but maybe it was a bit unfair, because we actually use quite a bit of TA when we're trading. It's just that TA on its own usually doesn't work. You would need something else in the market to act as some sort of catalyst for these things to actually play out in the way that we want to. So in the beginning here, we're just going to go through my workflow, and I will start to lay out some sort of fundamental basis from where we can start to introduce some of these concepts on. I will not dabble too much on supply and demand zones or support and resistance levels, because it should be, there's still so much content out there. So I'm just going to go through them quickly and just show you my workflow on how I structure these charts and keep some sort of structure so I don't mix everything together. As you can see, there's a lot of things going on here on the hourly time frames, but maybe to you it seems that like, how do you separate all of those things? It's too much going on the chart, but actually there isn't a lot going on here. Some of these things are just for like a mental note for me that there is something happening here, but we do not look at some of these areas here to trade by. It's more to complement our hourly levels sitting inside of these areas. Okay, so in the beginning here, I'm just gonna go through my workflow. So what I usually like to do is I start on the high time frames and then I work my way down, so I get a bigger, so I can see the bigger picture of things. And later on, we're gonna start to scale down to the lower time frames, because as I said in the beginning, almost all of our trades happen on the lower time frames, and we swing trade the market and we try to scalp as many swings as possible. But of course we can't just take blind trades based off technical analysis on its own, so we have to look at certain psychological patterns in the market, and the video is gonna, for the most part, be about them. So in the beginning here, let's just go through this quickly. If I remove the volume, so here you can see that we are in the weekly range and there's a lot less going on here. So what I usually do is I try to systematize everything in order to not clutter up my chart, so I can actually tell what levels I am trading by and what levels are just complementary. So this is sort of a structural basis I go by. So my weekly levels are green, and you can see that what my other levels are, active levels are blue, supply zones are orange, demand zones are green. So that's just to quickly show you on how you can structure your own charts. Of course you can use different colors to separate everything, but that's just what I've stuck with. So here you can see that we have some support and resistance levels in the market, and of course how you draw them is by connecting reactionary points within the market. Something to keep in mind is that we always want to target the most major swing points in the market, because otherwise we could go in and start drawing these areas from everywhere, and it's something that you have to learn on your own, and something that suits your personality or your style of trading. My areas might not be suitable for your style of trading, so again, this is just a showcase, and how I draw these areas are for the most part by eye. So I just try to map out reactionary points in the market. Something I see a lot of traders doing and beginners doing is that they start on the left side of the range and they work to the right side of the range. When I study professional traders, most of them or almost all of them start on the right side of the range, and the reason for that is because they always want to trade price action last, and that's a concept that I'm going to start hammering into you a bit later on in this video, and why the importance of price action last is. But for now we're just gonna go through levels here and talk about the supply and demand zones a bit later. And you can see that there is some support here, and we find support and we start churning a bit on this area where we get some weekly closes around here. So it's just a good level to complement maybe some daily or hourly levels sitting around here as well. And again, we don't trade by these levels. They're more for confluence than to trade by. Also, a quick tip is that you can see there's a lot less going on here. So what I've done is I've just hidden my hourly levels and daily levels from the weekly range, and again, that's just to get a more clear picture of what's actually going on. You can see that I haven't drawn in anything up here or down here either, and as I said in the beginning, we swing trade the lower time frames, and there's a lot of information going on in this area here. Sorry, we're trading in this area here, and we try to swing trade on smaller time frames. So what's happening down here or way up here is not really that useful to me, because I don't really care where the market goes on the larger scale of things, because as I said, we swing trade the market or scalp the market on the lower time frames. So where the market is heading in the bigger picture I don't really care about that, because I'm sitting on the sidelines for the most part anyways, and I don't try to hold trades for more than a day usually. So let's just go to the daily, and we can see that there is a lot more going on here. There is this blue line here that shouldn't be there. I'm just gonna remove that quickly. So here you can see that we have, if I bring up the schematic again, you can see that our daily levels are dark red, and you can see I've mapped out some of them here. There's not too much going on, and I have supply zones and demand zones here. So you can see that I've drawn out some daily levels here, and again what we usually like to do is we like to start, so if we can split this range in two, so I would say that this is one part of the range and this is the left part of the range. It's not too necessary how you split them, but just so you can like have some sort of where you split the range in two, so you can have some sort more active or present levels on the front of your mind instead of starting to looking over here or over here. So that just plays into the price action last concept I talked about earlier, but we're not going to talk about that for now because I don't want to confuse you. So you can see that I've mapped out some levels here. I try to connect reaction points in the market. They may not be perfect, but again, I just made this quickly before starting the video here, just to map out some of these things. And again, we try to look at major points in the market. I could go in here and I see that, oh, there's something over here, that we find something here. Maybe here I could put some sort of daily support or resistance level. And you know, I can go in here as well. I see that we find support and resistance and support here. So again, there is a lot of levels you can draw here. And again, we don't trade off of the higher time frame levels. These are just complementary or to complement, our hourly levels. So that's, you know, just a quick introduction to support and resistance levels in the market. These zones here are supply and demand zones. So up here you can see that we have a supply zone, and what a supply zone is quickly, it's a zone where market likes to come back up and retest these areas. As you can see here, we come all the way down and we come back up and we find new supply in this area, in this institutional supply zone. So we get a new supply of short selling, and for the most part I think there is some sort of overstacking of long liquidity sitting up here where the CM is capitalizing on. So I usually like to think of them as some sort of decision zone where the CM makes a decision for the market, for where he sort of fills up his positions, and we usually get some sort of reversal out of these zones, especially on these daily areas or daily support and daily supply and demand zones. But how can you tell that this is demand zone? Well, how we can tell that this is a demand zone is that we get this huge demand bar or outside bar out of this area here in the market, and we can now tell that there was some sort of supply zone here supplying the market with a lot of short selling. And usually when the market comes back up to test this area again, what usually happens if it's a natural zone is that we get some sort of selling here again, or a new supply of short selling. So over here you can see that we have demand zones, and again you can see that this area here, when we approached here, this was in fact price action last, and it's a lot more important to look at price action last than looking at this range to find something. So this would be much more important because the areas in the market here has already been tested or solved on this upthrust here in the market, and we have now created new problems for the market to come back up and retest and try to solve again. And that's, as you can see, we get some sort of short selling here, and we get some sort of supply rally as soon as we approach this zone. Something that's very important to understand as well is that you can see that we get a close on the icings here, not really, but we get some sort of close under this zone, which is a good factor for the zone to play out in its quote-unquote right direction. What also usually could happen is that you see down here we get some sort of close within. So we can get a close on the icings or a close within, and that's completely fine. But as soon as we get a close above, I'm starting to sweat a bit, because it means that this area has been somewhat invalidated and the demand has completely overtaken this huge supply zone, and it would be a pretty bullish factor for the market to completely just ignore these areas in the market. And sometimes it happens, especially on the lower time frames. We usually see, for example, here you can see that the market just completely invalidates this demand zone we created. We got this huge demand bar, and we get this demand zone here, and you can see that the supply is just completely overtaking this area. So if on a move up here, I already have the confirmation that this area is in fact not that strong, and I can use that, or just keep that in mind when the area starts approaching this area, that we could see some sort of violent reaction. And of course we don't use these areas by their own. We use a lot of indicators. You can check in with the VPVR to see if there is some sort of resistance in this area, which in fact there is some sort of resistance here on the top side, and you can use a lot of confluencing factors like that. But again, we don't trade off of these. So as I said earlier, we don't trade based off of these things in the market. We try to look for psychological patterns before we enter. All right. And how you draw, I forgot to tell you how you draw these areas. Since this is a supply zone, we draw it from the last bullish candle from this supply bar to the downward of its wick. Okay. And over here you can see that we have a lot of demand zones sitting in the market. And again, as I said earlier, we want to look at price action last, and there is nothing on this left side of the range to draw from. So we have to go all the way back to this side of the range, right? So here you can see we have some sort of demand zone, and how we can tell that this is a demand zone is that we have some sort of demand rally here. And here you can see that we have a demand bar, and how you draw a demand zone is from the last bearish candle to the upside of its wick. So you draw it from the close of the last bearish candle to the upside of its wick, and it's identified by the supply rally or supply bar that's coming out, or the starting point from this area in the market. And also as well, you could say, I'm not going to argue with you that, I mean, there is a demand zone here as well. But for the most part, when I have some sort of ranging area like this, I usually want to map out the top side and the bottom side, because usually they are more heavy in the market. And you can see that we got this huge move starting from this side, or this part of this small range here. So I would say that this in fact is more major than this, even though this demand bar is a lot bigger than this. So you can also see I have an overstacking here of demand zones. And you know how you draw them, as I said earlier, from the last bearish candle to the upside of its wick. And if we go back here again, you can see I mapped out these areas with these arrows here. And you can see that the market is finding new demand on the downswing here, and we are getting some sort of automatic rally out of these areas. So some sort of demand rally when the market picks up new demand. So it's just something to keep in mind, right? That the market is most likely going to react here. And we also get these wicks through here, down here, into these pools sitting down below these areas in the market. And for the most part, it's just a composite operator selling his own institutional demand zone in this case, in order to pick up the pool sitting down here. And you can see that we get, what's more important is that we get a close either on the icings or inside, on the icings or inside of these areas, this supply or demand zones in this case, that we get a close inside or on the icings of these areas. Because as soon as we start closing down here, it now gives me a sign that this area is in fact invalidated. And if the market moves down and comes up again, I know that this area is not that strong. So it's something I just keep in mind, that just something to have in mind when you're trading. So you can see down here we get a strong wick like this, and we get these tails here, and we get some sort of demand rally out of these demand zones in the market. But again, just for show, we can go in to the 4 hourly, and you can draw them on the hourly as well. Usually when you draw them on the hourly, you can get more precision or accuracy on your trades or on your zones. In fact, this blue zone here is in fact an hourly swap zone. I'm going to talk about swap zones in a bit here, But in fact, you can see that I get a lot of precision or accuracy on this trade, and we get a close on the icing of this swap zone in the market. Okay, so you can draw them on the hourly, that's completely fine, but for the most part I usually draw them on the 4 hourly to get a more bigger picture, because we do not trade off of these things. It's just for some sort of confluence. And you can see here we have a demand zone, sorry, we have a supply zone here indicated by this outside bar or this puking action in the market, and how you draw it is by the last bullish candle to the downside of its wick, just like this. And you can see that the market did shoot up here when we get a strong close below here. And as well as here, this is a bit more obvious maybe, we come back up here, and this is demand zone, but now the market is finding supply here, and this usually happens on the lower time frames where they act as some sort of pivots from being support to resistance or resistance to support. You can think of these areas as some sort of support and resistance areas as well. You can see that the market comes back into this area and just we get some sort of kiss here on the icing, and then immediately moves down. And this usually happens on the lower time frames where we get some sort of swap zone where the market swaps from finding demand and we instead find supply. And here you can see, as I said earlier, that it's very important that we get a close within or on the icings of these areas in the market. So we get this huge wick here, but what's more important is that we see a close inside of this area here. And you can see that we get this huge supply rally, not rally, but some sort of puking action in the market, and we move into this newly formed ranging market. Something else, just to map them out here, you can see here we have this huge demand bar in the market, and again how you draw it is from the last bearish candle to the upside. And you can see again that the market is coming back down to retest this area, and we find true strength in the market, and then we move higher. Okay, so the market always has to, these zones are for the CM to make a decision for where he picks up liquidity in the market, and it's usually in zones where there's an overstacking of liquidity, and he can capitalize on that, where he's selling the market or putting pressure on the market in order to reach these areas, in order to pick up liquidity and take the market into the other or the opposite direction of the slowly trending market or short-term trending markets. Okay, same can be said for down here. We have some sort of demand area here. It should be drawn like that, and you can see that the market is coming back down, and we are finding new demand here, and the market moves higher. So another way to think about these things is, if you're saying, let's say you have a springboard in the water like that, and this is the water, and the springboard is having or the water is pushing up with a force on the springboard which is equal to the force that the springboard is pushing down on the water, making or creating some sort of equilibrium where the springboard is completely still in the water. But let's say we have some unknown force that starts pushing down on this with larger force than the water can support. The springboard is just gonna sink below the water, and as soon as this unknown force lets go of the springboard, it's just gonna shoot back up effortlessly without this unknown force applying any pressure at all to the springboard. And we can look at the supply zones in the same type of way, where there is some unknown force pushing the market into these areas. And so let's say that I'm a large institutional trader, and what I do is that I push the market down into this area, and as soon as I reach this area I can start filling up positions, and when I let go of this downward force, the market is just gonna have some sort of automatic rally where this unknown force doesn't have to apply any pressure at all into the opposite direction, because the market is just gonna, as I said, have an automatic rally or sort of a relief rally from these zones in the market. And we usually see that happening. So that's a bit about supply and demand zones. We can also look at resistance levels or support levels in the market. So let's say that we have some sort of, I actually took this trade where I entered the market here and I started scaling out of my position in this area here in the market, because there was a lot of resistance. So if you look over here, this is now price action last, and there's not too much going on in this candle here, and even on the hourly there is just some sort of vertical absorption pattern in the market, and there's nothing we can draw any information from really. So we have to look at this price action here, right? And we can see that we have this huge supply zone that is very, very obvious in the market on the H4. And if we move back here, you can see that the market is finding demand now instead, and we get some sort of swap zone. And this is you can think of it as some sort of larger support level almost. Again, this is just to gain confidence on the market and to confidence our more psychological patterns that we trade by. And I saw some guy on Twitter talking about how this move down here was very unnatural, and I have to disagree with him. If we go back to what I explained down here, this is sort of what happened, that someone had to push the market into this area here in order to accumulate in this range here, and then we get this huge demand rally out of this range. So that's just something to look at. I know I'm just going really briefly on these things, but you don't have to worry if you don't understand, or if you think that this is a bit too messy or a bit too surface level. We will go more in depth later on, and I will go in the end when we have explained everything. We're gonna jump into a live session where I talk about these things in action in the market, and where we can actually start looking at how to take these trades. So I haven't mentioned yet how to draw support and resistance areas on the lower time frames. It's a lot like drawing the supply and demand zones, but again, we want to look at price action last. So we had this huge supply dumping action here, or puking action, where the market started puking into this box range here. So let's say that we entered the market here just for show, somewhere in this area here, and now we're looking to take profit. Well, we have to look at price action last, and in fact price action last in this case would be this and this, right? So of course we can't foreshadow if the market is going to go higher, and you know, in this case we already know. So you can see that the market is going higher. We get this wick through here, we get this wick here, but again it's not taking out this candle here, so I'm not really stressing it, and I would tend to hold this trade a lot longer until we reach this inverse last price action in the market. So if I remove these things, and we can just map out this area here. So I would like the market to come back up and test this inverse last, meaning that the market is now pivoting and we're coming from below, and I want to see some sort of resistance in this area where the market pivots from being support into being resistance in the market. And here you can see that we get a swing failure, and we're going to talk a lot about the swing failure pattern, because it's one of the most effective ways to trade the market, to be able to identify these things in the market and why they happen all the times. And they are fractal, meaning that they happen on all time frames. I know I'm rambling a bit here, but again, this is just to create some sort of structure for you. So if we took this trade down here, I would try and run this trade to this area here, and you can see we get a swing failure, and we get a strong close below here, and then we get this supply bar or outside bar moving down to retest the icing of this previous swap zone in the market. But again, I'm just showcasing you this structure here, and that's the point. And we want to look at price action last always, and try to target swing points in the market for the market to come and test again. And as I said, we are swing traders on the lower time frames, and we want to trade these swings in the market. And usually what the market likes to do is we get this huge thing like this, and we start ranging, market moves higher, and we're now forming a new range, and we're going to start ranging a bit until we move higher or lower. And you can make a lot of money just trading where nobody else is trading, because most people want to catch the big moves in the market. So most people tend to stay avoid of trading this churning price action. But if you know how to do it, and you know how to work your stop loss, and you can greatly improve your strike rate on these types of trades in the market. And we're gonna start looking at especially this swing failure pattern in the market, and why it's so effective to look for. So I'm just gonna pause the video here again, and we're gonna move into Paint, and we're gonna start to structure some sort of market where we can look at some of these examples more clearly.
Alright, so now we can start to actually map out or to look more in depth into some of these strategies or more psychological patterns within the market. So of course I'm gonna just sugar pick an example here. So let's pretend that we have a market that's looking something like this. We are in some sort of downtrend like this, and let me just map this out really quick. And we're starting to reverse a bit here, but we're still in the downtrend, and it's important to understand that when we showcase this. So we are in the market starts to cool off a bit here when we reach this area in the market, and we start to range sideways like this, which happens quite a lot. So let me just map out something here. So let's say that the market is looking something like this. Overall, we are still in a downtrend, and let's just, for show here, pretend that we have something sitting up here as well. And there is some sort of trouble area or a danger area up here for the market to potentially start attacking. We can call this area NDA, next danger area. And so a potential trade would be to sort of target this area if we have some sort of potential or genuine breakout happening in the market here. But of course we can't foreshadow these moves in the market. But let's just establish some things first. So again, let's just pretend that we have some sort of rising demand volume in the market, where there's buyers are slowly overtaking sellers in the market, and you can see that we have a sequence here of higher highs and higher lows, and we even take out this swing high in the market over here, and we also took out this swing high in the market. Okay, so we're making a sequence here of higher highs and higher lows, and we're creating some sort of smaller uptrend. And also, before I forget, let's pretend that we are looking at the H1 time span, and that this ranging area here is over a time span of a day. So we have some sort of rising demand volume here. Of course, in an uptrend, demand has to overtake supply, and demand has proved itself in this uptrend into this market here. What usually happens when the market starts to range like this, you know, we could see some sort of vertical absorption, or something like this, where the market is cooling off vertically and not sideways. But just in this example, we're going to try to keep it as simple as possible. So let's pretend that the market is ranging in a sideways manner like this, and our job here, we're trading at the icing here, and we have some sort of 3 touch on this resistance level in the market, and our job here is to sort of identify what could potentially happen here, and what would be our best strategy to trade this. So we have, usually what happens when the market starts to cool off a bit is that demand volume starts to fade as well, and we usually see something like this in the market, where this area here, I'm just gonna mark it in orange because you can't really see yellow. So usually what we see is some sort of climax here, where the market starts to sort of redistribute positions, and the demand volume is usually, or supply volume is usually, demand volume is usually at its highest point in the market in this area here, but then slowly starts to fade when we start ranging sideways like this. And something that usually a lot of traders they pick up on is that they look at the volume and they say that, well, the volume is fading here, I'm gonna wait for the volume to pick up again before I want to enter this trade here, because it's too risky to take this trade on a fading demand volume. Just for an example, something you have to realize is that we have a proven uptrend here. We have a sequence of higher highs and higher lows here, and demand, as you see here, has already proved itself. So if the market is going to move higher here, we do not need to see new demand entering the market, because demand has already proved itself in this upswing here. So that's why the volume candles here in this ranging area is not really relevant. And something else to keep in mind is that you can start to it's not fair to judge the volume based off of in this range here, or more like the left side of the range here to this right side of the range. You always have to look at the volume into the context of the trading area that we're currently trading within. So we're mapped out this trading schematic. Overall, we are in a downtrend, but the market is starting to reverse a bit here, and it's our jobs to sort of identify what to do when the market is approaching this area in the market. Something else to keep in mind is that the longer we range sideways like this, the more pressure is going to start building up on both sides of the range here. So what I mean by pressure is that the longer we trade sideways like this, there's going to be a lot more participants taking being present in the market and taking trades. And in a ranging market like this, there is a constant transfer of risk between buyers and sellers in a manner like this, where we see a lot of buying, and especially on the icings we usually see some sort of if the CM decides to either, in this case you can see that the CM has defended both icings of the range here, showing strong hands by distributing up here and accumulating on the icings. And for the most part, when we see this, when the market is just bouncing in a range like this, the accumulation phase of this range takes place on the icings here of the market, and not so much within here, because it's usually low volume traded sideways like this, and these peaks or swings in the market usually are the ones that contains the highest amount of volume in a sideways trading range like this. So back to what I said earlier, well, we have some sort of pressure building up here on both sides of the range, and what I mean by that, there's a lot of participants trading within here, and something you have to keep in mind is that we have this swing high and swing low here, swing high, swing low. Now these are, let's pretend in this example that it's just perfectly they are touching the same resistance area, or we're seeing distribution at the exact same price in the market and accumulation at the exact same price in the market here. Now if you're a buyer here and you've been buying this range, you could have entered anywhere in this range here. For the most part, if you're a buyer, if you're a retail trader, what most retail traders tend to do is they stick their stop loss under the previous swing low in the market. So if you're a buyer, there's going to be a lot of stops sitting here, buy stops, and I've already mapped them out here in green. So there's going to be pressure here from the buy stops if the market decides to move down here, and the same for here. If there is a lot of shorting going on in the market here, most of those people are going to put their stops above the last swing high in the market, because if the market comes back up here, they don't want to be in the trade anymore. So they rather be stopped out in a small amount of, or take a loss on a trade rather than get completely caught on the offside of the market. So there's a lot of pressure building up here. There's also people that want to trade this potential breakout here. There is also going to be a lot of limit orders sitting around this area here, because if the market decides to move, they want to catch the move early. So they have limit orders sitting here. Same for here. They want to catch some sort of breakout here, and they want to catch that trade early and get in on the move immediately. Now, what our jobs here is to try and swing this, and we can't really foreshadow if the market is going to start surging from here, or if it's going to start puking and test this side of the range again and for a potential breakout. Maybe this was some sort of distribution phase in the market for us to move lower and start reaccumulating again for a potential move higher. So these things we cannot foreshadow these things. So but what we can do is we can identify some of the possibilities here, and I've already started mentioning some of them. We could see some sort of genuine breakout into this NDA area in the market, and we start ranging a bit up here for a potential move up or a potential sell-off. So that's one possibility that it could happen. Something else that could happen is we see something like this where the market moves up into the NDA and then starts ranging a bit. And especially on Bitcoin, what usually happens is we see some sort of surging price action where the market moves really violently, and then it starts to fail like this, and then you just move immediately down. And you know, we get this famous BART pattern, as a lot of crypto traders like to call them. And you know, we come back down again here to retest this area again in the market. So that's also a possibility that it could happen. And of course there's a lot of, you know, there is a lot of, we could start churning a bit, we could come back down, test the 75% and then move higher, or get some sort of 50% retest of this range in the market. But now we're just mapping out some more simple ways of looking at the market, and that usually happens. So we could see a genuine breakout, we could see also a genuine breakout, but then some sort of retest of this area where we get some sort of retest of this swing here in the market, this swing high, and we would get something called an inverse last retest, where resistance pivots into being support again. So that's something that could happen. We could also see some sort of triple top action in the market, where we get some sort of sell-off again on this icing here, where the CM is defending this area instead of starting to attack it. And you know, we could go and range even further, or we could come back down and test the other side of the range like this, and we would have to react to what the market decides to do when we reach the other side of the range like that. Something that also usually happens, and this is what we're going to talk about, is a way more psychological pattern. Because as I mentioned earlier, we have these liquidity pools stacked up here in the market. I'm just going to mark them out for you. I'm also a bit sick, that's why I'm coughing a bit. Sorry for that. So we have these liquidity pools here stacked up on the icings here, or outside of the icings of this range here. Now what usually could happen, or what usually happens, especially on the lower time frames, is we see some sort of breakout like this. We just push through this liquidity pool in the market, and what's also very important to keep in mind is that we take out the previous swing point in the market, okay, and we have now created a new swing point. So what usually happens is we see something like this, and there's going to be a lot of FOMO buying of a lot of breakout traders, market buying this as well, and we're going to pick up the stops and the limit order sitting up here. And something else that could happen is you could get margin call here if you're in a short position and you're forced to start long covering on this breakout here. So there's a lot of things going into these types of candles, and of course there's a lot, there is institutional buying as well, pushing this move, or sort of acting as some sort of catalyst for itself in the market in order to pick up the liquidity here. But we're going to talk a lot about that later. I just want to show you that we usually see a breakout like this, where we break this previous range, and then what happens is that we get something like this. Alright, now what happened here? We have now taken out both of these swing points in the market. We did break this top icing here of this range, and we picked up all of the liquidity here, but for some reason the market came all the way down, and we get a close, sort of a pin bar close like this in the market, or we get some sort of close slightly above or under this icing here. So what actually happened in this candle? Well, for one, we get a swing failure in the market like this, where we take out the previous swing point. So we can call this SF. Okay, so we have a swing failure here where we take out this swing, but we fail and we come back down, and we get a close somewhere in this area here of around the previous swing the previous swing high in the market. Now what's actually happening here? Why did this happen in the market? Well, for one, we did pick up all of the liquidity sitting up here, and there is a lot of people now trapped on the wrong side of the trend like this. You know, if you're a breakout buyer here and you're sort of targeting this area or some area up here for a potential profit, and the market just comes all the way back down and the market just stops like this and comes back down on itself, you know, you're now trapped on the wrong side of the trend, wrong side of the trade, or wrong side of the trend. And also the people that shorted this range here have now been stopped out, so they are also trapped now on the wrong side of the trend, and we see this sort of stopping action in the market where we're farming all of the stops and also trapping a lot of traders on the wrong side of the trend like that. We usually see something, a follow up to this candle with something like this. Now, why does this happen? Well, as I said earlier, there is a lot of people trapped here. So when the market comes down like this, most of these people, they want to get out of the trade because they now realize that they are trapped in the market. So what most of them do is they start market selling and they start puking, and everybody starts puking together. And what's also happening when these guys start puking, well, the people that have been buying this and didn't take profit up here, well, they are now gonna start puking the market as well, because they are underwater. They are now underwater in the market with these guys. So everybody starts puking here, and there is no demand in the market because nobody wants to buy this huge red bar. So there is just an overstacking of supply in the market with no buyers, and we create some sort of puking action in the market like this. Okay, but what triggered this move here? Well, I can show you with an example that's pretty accurate. So, or not accurate, but it's easier to understand. Well, if we have some sort of springboard in the market like this, and the water is pushing up on the springboard with the same force that the springboard is pushing down on the water, and we create some sort of equilibrium here where the springboard is just laying still in the water. But what would happen if we get some sort of unknown force that starts pushing down on the springboard with a lot greater force than the water can support? So now the springboard is going to start sinking, and it's going to go underwater like that. Now, what would happen if this unknown force stopped applying pressure to the springboard? Well, the springboard would move up again effortlessly without this unknown force applying any effort. So it moves effortlessly without anyone pushing it to the surface and even above the surface to then move back down again. Now, if I flip this, if I take this whole schematic and we flip this, do you see any similarity with this example up here with what happened down here? Well, to understand this, you have to realize how a larger institutional investor thinks, or how a composite operator is operating in the market. If I'm a larger institutional investor here, I can't just start selling the market here. What I can do is I can start distributing all of my acquired positions here that I have accumulated in the market somewhere in these areas. But I can't start selling as well as distributing the markets, meaning that I can't fill short positions at the same time as I'm redistributing, because if I would do that, I would start pushing the market lower immediately. What I need to do is, I can't just start selling here, because all of the order flow traders and more professional traders, they're gonna see me in their order book, they're gonna see that somebody's pushing the price down violently, and everybody would start front running me in the book, and I would see something like this. And as a large institutional investor, I don't want to have to deal with large spreads in the market. I just want to get filled somewhere up here, or get filled in a more concentrated spot, so I can avoid spread in the market. So if I start selling here, I'm just gonna get front run by all of the retail traders and specs and funds, and I'm not gonna get the sought after effect in the market that I want. So instead we get some sort of slow distribution up here, but again, I'm not acquiring any short positions as a large institutional trader. So what I have to do here is I have to start buying the market. Okay. So in order for me to buy the market, or in order for me to sell the market, I need to buy the market. Now what I mean by that is, as I mentioned earlier, I can't start acquiring short positions in here because I can't distribute the market and acquire short positions at the same time. So what I have to do is I have to start buying the market here, and especially on this icing up here, where I'm now starting to attack this area in the market, and I'm acting as my own catalyst for this potential move or for this breakout to happen. Now when I start buying here, there's going to be a lot of FOMO buying and a lot of market buying, and we're also triggering all of the liquidity sitting piled up in this area in the market. Now what happens if I apply a lot of pressure, just as in here, where I start applying a lot of pressure to the market and then I just immediately stop? So if I stop applying pressure to the market here, well, there's only going to be a lot of retail traders trying to push the market higher here. And of course, a retail trader, he can't push the market by its own force. He needs large institutional investors to push the markets for him. And when large institutional investors stops buying here, it sends a signal to all of the other CMs in the market to stop buying as well. And we're gonna see some sort of stopping action like this, where the market just falls on itself. Now what happens here, well, somebody picked up all of the liquidity sitting in this area that had now been piled up in this ranging market schematic like this. So when all of this liquidity has been acquired in terms of short selling, I stop buying the market. So I'm playing both sides of the market here, and I'm pushing the market at the same time. I'm absorbing all of the liquidity sitting up here. I'm absorbing the buying going on in the market here. I'm absorbing the short stops in the market. I'm absorbing all of the long covering, and I'm absorbing all of the breakout buyers in the market here. And when I stop applying that force, the market usually falls on itself like this. And as I said earlier, there's a lot of people trapped here now, and they are now looking to get out because they realize, well, this was a stop hunt, I better get out of the trade quickly. But everybody's gonna think the same, so everybody starts panicking here, creating a panic for this range to start panicking as well, and the market is just sort of falling on itself, where it's falling on its own liquidity pools in the market like this. And the further we fall, the more panic it's going to cause, and that's why you usually see a really violent move after this stop hunt in the market or this swing failure pattern in the market. So I need to buy the market in order to sell the market, because there is no liquidity sitting here, but there is a lot of liquidity sitting up here, and especially if we've been ranging sideways for this for a long time. You know, the longer we range sideways like this, the more pressure is going to be built up on both sides of the range like this. And just as in this springboard example, we see the same effect in the market when we start moving through these zones. And that's why we usually see such violent reactions on the way down. And that's why this concept is very important to keep in mind, because you can't think like a retail trader. When you're trading, you have to think like a larger institutional force when you actually start to day trade. Because if you still have the retail mindset of swing trading markets, you're just gonna be trapped with everybody else when these things happen. And you know, of course we can see genuine breakouts happen, and it's not really reliable to be a breakout trader because it's so risky to try and catch these moves. But more times than not, we usually see something like this in the market. And when we see these things in the market, well, we are on the H1 now. Well, this thing could happen on the daily, it could happen on the weekly, it can happen on all time frames, because this pattern is fractal in a way that it's happening constantly on all time frames. You can go to the 5 minute and you're gonna see this happening all the time. And the market usually moves into the other direction when we see something like this, because now there is no liquidity up here and somebody has gotten a fill with a big short position, because on every contract there has to be a buyer and a seller. So on all of these buyers here, there is somebody who's selling the market. And when these people are trapped, they want to get out of the trade, and it's causing major panic to the rest of the buyers in this range here, and everybody starts jumping on the book. And usually what happens is that if the market, we get a squeeze like this, the larger squeeze we see in the market, the further this move down is usually going to be. Because if we only had a small squeeze like this, well, the possibility of the market coming back up and squeezing twice against us is more likely than if we would get a huge squeeze like this in the market. And especially if we see a huge squeeze on the daily like this, and we move to the lower time frames and we see the same type of pattern on the lower time frames, we can use the higher time frames as some sort of confluence to complement our lower time frame trades and give us more confidence that this in fact is going to play out. Because if you're looking on the higher time frames, of course there's going to be there's a lot more force going in to the higher time frames, and if you can see something like this on the higher time frames and on the lower time frames as well, it's just going to complement this type of trade, and we get more confidence that this is in fact going to play out in our favor here. So how you would enter this trade? Well, either you enter on the icing way back down, or you enter on the close here and you put your stop loss above this squeeze point in the market, or this newly created swing high in the market, because usually the market doesn't come back up and squeeze us out again. What could happen is we start churning a bit here and we get some sort of second squeeze, but I'd say for 90% of the time the market usually doesn't squeeze against the first squeeze in the market. And of course you have to use your own judgment here, but for the most part the market usually doesn't squeeze against us. And if it does squeeze against us and we do get stopped out way back up here, we can just re-enter the market again down here, because usually the market doesn't make a huge squeeze like this against us twice. And you're gonna see this when you start looking at the markets, that this is happening a lot, and you're gonna be able to build up your own data and your own strike rate on these types of trades, and you're gonna be able to see it's almost like looking in the matrix. And it's crazy how often these types of trades happen and how little they are talked about. Usually people talk about stop hunts, but they don't really understand the dynamics that goes in to these types of trades, and especially in conjunction with sort of a ranging price action. So it's important to understand that. And if we want to target a point in the market, well, we could target the other side of the icing and take profit here, or in this case we may have something down here and we can take profit here. Now what's happening here is that, so let's say that we get a huge violent move like this where everybody's puking the market and we start facing this icing again here, and again the same type of dynamic is going on down here as well, because as mentioned previously, all of the buyers, well, most buyers or more of the smarter guys, well, they're gonna have stop losses sitting down here. So if they're not puking this range here or puking this candle here, they might have their buy stops sitting way down here still. So what market usually likes to do is, well, it comes back down and it picks up these guys and takes them out of the market, and then comes back up again, and we see some sort of 75% test or 50% test of this ranging market here, and then we usually move down. And what's also happening here, as stated up here, well, we're gonna have new breakout buyers shorting this market here, and those guys that started shorting this breakout usually are the same types of people that market buys or limit buys a breakout like this in the market, and these guys are now as well gonna get trapped. So if you're a shorter here, well, for the most part you're gonna put your stop loss above the last swing point in the market, which in case is this here. So we would probably have a lot of stops sitting up here, and the market comes back down, picks up the liquidity here, traps a lot of people on the offside, comes back up, takes out these stops in the market, and then moves higher. So we're constantly farming liquidity in this way, and the market is always operating by putting as many people on the offside as possible, because if there is a lot of confusion in the market, that's usually when we can make the most types of money, because it means that there's a lot of traders that are trapped and are sitting on the offside. And you know, the market is usually acting in the most ruthless way possible, trapping the most people that it can in acting this way. So it's a very natural way for the market to act, because it means that there's going to be less people actually making money trading these types of setups in the market. And if you miss this whole move here, well, what you can do is you can go for some sort of reshort when the market comes back up, to test this area again, to try to get a feel here and play, you know, some sort of potential move, maybe down here, or target somewhere down here again. And what we usually like to do is that we want to trail our stop with these bars in the market. So if the market decides to come back up and squeezes out again, we usually want to take profit in the market, because we can't really foreshadow how far a move is going to go. So we usually want to trail our stops, and I'm not going to be talking about stop losses here, because there is no real way you can systematize it, because there is always, you know, you can't have one certain way of putting a stop loss. You can use some sort of volatility based stop. You can look at the ATR for an example, or you just look at the more major supply candles, and you're adding some padding where you're putting your stops slightly above. If you would have a candle that's looking like this in the market, well, usually what we want to do is we want to put our stops a bit slightly above this previous supply bar in the market, because the market usually doesn't make some sort of demand candle up here again. We usually see something like this instead, where the market maybe comes up here again and it's looking something like this. Alright, so we usually want to trail our stops with these types of trades, because we're constantly working the markets and trying to move in and out and swing trade these types of trades. And we don't want to give back profits to the markets either, so we try to take profits when we can, or when we meet some sort of NDA in the market. And we also can use these types of patterns in confluence with technical analysis. So just for show here, let's pretend that we have some sort of Bollinger Band going like this in the market, and we get a breaking of the Bollinger Band in conjunction with this swing failure, in conjunction with this pin bar close, or this some sort of, you know, it could be a high wave candle. But there's a lot of things that you can use in conjunction with these types of trades, and confluence, or to complement these types of trades, just to give us more confirmation that it's in fact going to play out. You know, we could also have some sort of, you know, let's say that we have some cloud up here on the Ichimoku, and the market comes back up, and we get some sort of touch like that, and the market comes back down. So you can use moving averages, clouds, whatever indicator you're using to sort of identify these types of things. Maybe you had some sort of divergence here, where you have where the RSI, for an example, is going like this, and you have some sort of bullish divergence on the RSI in conjunction with these types of things. And again, it's just using what we can in the more technical way to gain more confirmation on that the trade is going to play out in our direction. Now we can actually look here. I've actually established some sort of, just to give you an example of some confluencing factors we can use. Okay, I'm gonna pause the recorder here, and we're gonna go back and we're gonna look at the other paint document that I've established on some confluencing factors we can use in conjunction with these types of, or this swing failure pattern in the market.
Okay, so here you can see I've sort of put together some of the examples, or some of the things that I look for
And when I look for confluencing factors on my swing failures in the market, or on the stop hunts or liquidity grabs in the market, and usually what I try to do is I try to look for them on the higher time frames, especially if I have a swing failure on the lower time frames, or vice versa. So I always want to have that higher time frame directional bias on my lower time frame trades. And if I can't get a higher time frame bias, I tend to be more worried, or be more cautious of the trade. And instead I would have to sort of check for certain rule sets about the swing failure. I'm not going to be talking about the rule sets of the swing failure in this video. I might do a follow-up video, but just to give you like a hint, what I'm talking about here is that if we get a swing failure out of an inverse level in the market, such as this here, you can see that this is an inverse level, and if we would have more touches on this area here, depending on how many touches we had on the inverse level into the swing failure, I wouldn't need as much confluence, for an example, because usually inverse levels tend to be stronger than just regular support and resistance levels in the market. So that's just some of the things that I try to look for. But there is way too much to be talking about just the swing failure. I could maybe do a follow-up video just talking about the swing failure and not everything like I'm trying to capture in this video. But these are just some examples, and again, this is by far this is not even close to everything, but these are just some of the examples that I for the most part look at. But there is a lot of other things, and in the live session we're actually going to look at, for an example, we're going to look at wave trends, and we're going to look at the commodity channel index and how we can use that with the RSI and with the other indicators to sort of check for dominant energy levels in the trend, etc. But let's just go through here some of the things that we look for. And again, if you're a pattern trader, you can use your patterns such as the triangle pattern, ascending triangles, descending triangles, symmetrical triangles, bullish and bearish wedges and flags, etc. And in the example previously, we looked at the distribution channel in the market, and sometimes if you're a Wyckoff trader, for an example, it's second nature to you to sort of look for these springs and accumulation distribution zones inside of the markets, so you already know that. So if you're interested in the swing failure and the dynamics behind it, I recommend you reading Richard D. Wyckoff's work on this, because it pretty much goes hand in hand, and we're pretty much explaining the same types of dynamics and market psychologies that goes into these types of trades here. But again, I'm just gonna read this through quickly here for you. You can look for double tops, triple tops. For an example, when people see a double top like this is actually really weak, and the market comes down here again. This is not something that we usually want to look at. This, if we see this happening, now this double top is a lot stronger, and the force, the downward energy or the downward momentum is going to be a lot larger, or the pressure to the downside is going to be a lot stronger than if we would just top out without seeing the liquidity grab before. So these are just some things that we can look for. And also we have the standard patterns such as head and shoulders, inverse head and shoulders, cup and handles, diamonds, wolfie waves, harmonical patterns, rounded bottoms and tops, Adam and Eves, etc. So again, it's important to understand the patterns in the market, because sometimes, you know, even though you're not using everything, you know, because there's a lot of things that you can study in technical analysis way, even though you're not using everything, it's still important to have everything in mind, or sort of in the back of your head, because you sort of understand the market a lot better if you would just be like sort of focusing on the more popular patterns. You're not gonna see the market from different approaches, and usually you're gonna be very one-sided or have some kind of bias on your trades, and we usually want to stay avoid of putting our emotions or letting our emotions or how we feel determine our decisions in the market. We can also look at candlestick patterns, especially if we have a swing failure. Let's say we have a swing failure on the hourly or 4 hourly, and then we go to the high time frames and we might see some kind of high wave. We see a high wave at the bottom of a trend or at the top of a trend on the daily, for an example. And these are just some things to look for, right? And you can look for engulfings, dojis, hammers, pins, piercings, tweezers, spinners, and there is a lot of hangmans, shooting stars. So just having the sort of studying candlesticks can also be a good way to sort of determine, or not determine, but to sort of complement the trade, because the more things we line up, the we can gain a sort of a confluence of different factors as up here when things start lining up together, and especially on the higher time frames. We can sort of, when we move to the lower time frames, we can sort of try to run our trades a bit longer, instead of just taking profits from a swing failure to the NDA. And I'm gonna show you in the live session what I mean by this. So if you don't really quite understand these things yet, you don't have to worry, because in the live session we're gonna be talking about these things. Well, you can also use indicators here. Again, I've just listed a few here. There's a lot more that I use, and in the live session we're gonna look at that. But for the most part, I try to look at the Ichimoku cloud. I would say that it's easily one of my favorite indicators, and I usually use the standard settings, or I use the 20/60, 120, 30, and I never use the Ichimoku cloud on the below the 4 hourly. So I usually just stick with the daily and the 4 hourly, and switch between those when I'm looking at the Ichimoku cloud. And again, in the live session we're going to be talking a bit more about the Ichimoku cloud. But again, this is not an explanationary video where I explain these things in depth, because I could probably spend the whole video here just talking about some of these indicators here. So something else we can look for: higher time frame supply and demand zones, weekly and daily support and resistance levels, that are sort of complementing our hourly levels. Also, I'm not really a big fan of moving averages, but you can use the moving average. I usually run the moving averages on the hourly or 4 hourly. You can do it on the daily as well, but for the most part I stick with the moving averages on the hourly. I either look at the 20, 44 or 100. I don't really like to shake for golden crosses or those types of patterns. For me personally, it doesn't really suit me. Something else you can look at that I actually look at quite a lot is the VPVR. I check for gaps and problem areas, and again, these things can sort of complement and sort of give us or sort of complement our trades in ways, and it's sort of, you sort of have to make a mental note. For an example, if the market is, so let's just make an example here. So if the market is trading like this, and we have sort of touched this area, and you can sort of see that the market wants to go through. The more times we test an area like this, it just means that the market sort of wants to go through here, especially when we're dead cat bouncing on the level like this. And we might see something like this where the market comes all the way down here and then comes back up here again, and we see the swing failure in the market like this, and then the market moves higher, for an example. So we might have had something down here. For example, we might have had the Ichimoku cloud sitting like this in the market, and we might also have some sort of Bollinger Band sitting like this. And when we see a break of the Bollinger Band into the lower signal of the Kumo support, you sort of get what I mean here, that these factors can sort of line up in the market. And when we see the swing failure, now I'm especially scouting for these types of confluencing factors, and I'm especially scouting them on the higher time frames, meaning H4 and the D1. For the most part, all my trades happen on the H1 or H4. I would say the H1 is my go-to time frame for entering trades on. Okay, something else we can look for are Fibonacci levels. Usually I run them on the H4 or daily. If something I do is I sort of connect swing points on the daily to gain sort of a cluster zone. Again, we're going to look at this more in depth in the live session, where I gain a cluster where certain Fibonacci areas sort of line up in the market, and again, it's just going to complement and confluence each other and we can use all of these things in conjunction after a while when things start lining up. You can also look for pockets sort of as the 0.65 to 0.68, or especially if you're an altcoin trader, you're gonna especially like the 1.236 and to 1.272. I have an amazing strike rate of trading that particular pocket, especially on altcoins. If you manage to draw the Fibonacci, if you manage to draw the Fibonacci sequence correctly on an altcoin or mid cap, that pocket is it's always reacting. The market is always reacting to that pocket. So if you do that, you can go back and back test that. So cluster extension areas, that's what we just talked about here. Something else to look for are sort of 3/4 tests or sort of a 50% test of a range or a trap bar, meaning that if the market moves like this, usually the market wants to come back up and test the 50%. Or sort of the 75% level where we get a bounce short like this. So these are some things that usually happens within the market where we sort of want to come back up and see if is it true weakness or true strength here, and you can sort of gain an answer from the markets by doing so. And again, we already talked about the Bollinger Band break, especially when we break the Bollinger Bands into a swing failure and then comes back up and we get it close, or comes back down and get it close inside of the Bollinger Bands. That's something I look for as well, and you can look for the typical squeezes in the market. So also something to look at, pivot points and divergences. You can look for extraverted divergences, there is hidden divergences, and there is natural divergences. We're going to look at that as well, especially on the RSI and the OBV. And as I mentioned before, I usually look at the wave trend, Wise waves, commodity channel indexes, and sort of use that as well, especially on the higher time frames. But we're going to look at that we're going to look at everything. So if you don't get it, you don't have to worry for now, because in the live session I'm going to try to sort of cover as much as I can here. Also, price neutralizing and slow grinding of fading volume is also something that I usually want to stay avoid of, meaning that if the market comes and sort of goes supernova like this and then comes back down, and we might get for example, we might get a bounce short like this and we come back down here and the market starts neutralizing, and especially if the volume sort of fades like this and we see some sort of slow grind or vertical absorption phase in the market where we get candles like this that are slowly sort of grinding the market, where we get like a slow grind. Usually on the Bitcoin charts we have 3 demand candles like squashed together tightly. And we don't really I don't want to see any tails on these types of candles. And when we start slow grinding out of a price neutralizing area like this, especially if the volume is fading, this is something that I usually want to stay avoid of, because there is a lot of order flow traders and people look at the volume and they say that the volume is fading here into this slow grind, and there's going to be a lot of shorting trapped in between here. And those shorts are sort of gonna fuel the market when we reach this area here, and we usually see a big move out of these slow grinding phases in the market or vertical absorption phases in the market. And again, we're gonna look at that in the live session as well. Something else to look for are volume conflicts. Again, if you're Wyckoff traders, you already know about these 3 laws, so to say, of the market, and one of them is volume conflict, where effort doesn't meet reward. So if you have a huge candle like this and the volume isn't supporting that type of price action, you can make sort of a mental note that there is something wrong with the market here, and you want to stay avoid of sort of longing into this or shorting if it's a supply bar. So that's something to look for as well. And identifying trends is also useful, especially on the higher time frames. You want to see sort of where the market takes out the major swing points and sort of creates higher highs and higher lows. If we want to sort of if we want to maintain the uptrend, we want to see higher lows and higher highs, and otherwise, and the opposite goes for downtrends, of course. against squeeze patterns. That this is just what we're going to be talking about. We're going to be talking about the swing failure, liquidity grabs and stop hunts, and sort of trade these areas, because we always want to be on the same side as the CM in the market. And of course we can't trade as the CM, but we can identify what the CM's plan is through the price action, and when he has sort of made his moves, we can start entering the market as well right after. Identifying where traders are trapped, caught on the wrong side of the market. This is sort of what we looked at in the previous schematic, where I showed you this ranging market where we are ranging sideways and the pressure is building up on top of the icings, or at the bottom of the icings of that range, and sort of understanding that most people trade that way. It's useful because it means that we can sort of capitalize on their confusion and their anger in the market when it goes against them. And of course, D1 swing failures. If we have a swing failure on the daily and we move to the 4 hourly and we see a swing failure on the 4 hourly, and we move to the hourly and we see a swing failure on the hourly as well, you sort of have a swing failure across all time frames, and that is again just going to complement that trade on the lower time frames. And in an uptrending market, we usually want to look for a spring for entry, and in a downtrending market, we want to sell the upthrust. So if we have an established downtrend on the higher time frames or on the major scale of things, if the market decides to come back up again, I'm gonna lean more towards shorting than longing, and I want to see demand sort of proving itself before I make a decision to I don't want to trade against the trend. Basically, a trend is your friend, so you want to be with the trend always. And again, sell into strength, buy into weakness. Again, we're gonna look at that. I'm gonna show you some trades I did on the live session that were I had a really successful week here, and we're gonna sort of talk about what type of dynamics I looked for, and how I sort of how I played those types of moves in the market. So you don't have to feel ashamed if you took profits into if the market did go supernova and you took profits into a huge demand bar. There's no reason to feel ashamed, because we can't foreshadow anything. And the same is if you bought into weakness and you might have gotten stopped out. Maybe if you bought a swing failure into sort of a puking market and you did get stopped out, it happens. But if you stick to these things and you have a discipline and staying patient, these things are going to you're gonna be successful in the long run by doing these types of things. Checking for long versus short ratios. We're gonna look at the open interests as well, and sort of look at climax points and weak points in the ratios to sort of and especially in conjunction with the CCI and the wave trend and the RSI. I've already made that part of the video, so we're gonna look at everything we're gonna look at everything you see here in the live session. And again, patterns and indicators does not work on their own. They are solely used as cannon fodders for the CM to form specs and funds. If you're a pattern trader, or if you trade the more traders they come into the game and they sort of are hungry to make profits, and they don't do any deep kind of research, and they if you can't cheat screen time. Okay, screen time is extremely important. You can't study yourself into screen time. It's something that you have to just do, and you sort of after a while understand these things in the market. And if a pattern has less than or equal to 49% strike rate on its own, it's literally useless. And that's something else that I have a lot of data on, especially the head and shoulders. It plays out, the head and shoulders in the market, especially on the Bitcoin market, it plays out sort of like 45% of the time. And in the long run, it's not a trade that you want to take. But used in conjunction with market psychology and swing failures, we can start to extract new, more leading data from our journals and improving our strike rate on the traded markets. And all we can do is minimize our risk, and that's what trading is all about. Reality is that risk management is 90% and the other 10% is used for trading, pretty much. So risk management is key You always want to protect your profits, and you want to cut your losses when the time is ready. Okay, and you always have to use your sort of stop loss, especially since we're swing traders on the lower time frames. It's vital that you use a stop loss. Okay, I understand if you're more of a position trader, a stop loss might not be key for you to use because you're sort of targeting more major areas in the market, and if the market moves against you on a position trade, it's not the end of the world. So, but these types of trades, or my style of trading, it requires that you have a stop loss. Otherwise, it's not going to work. So it's important we have a discipline, and a lot of people don't have that, and that's why 90% of people fail in day trading. Because for one, they are not patient enough to wait for these setups. They want to trade all the time. They don't put any effort into screen time. You have to watch the charts. I say that if you want to be a day trader, you can't spend less than 10 hours a day watching the charts, and it's going to take many years to build up sort of an understanding of the market. And also keeping a watch list of your most traded markets is also a vital part, because all markets have their own character, and it takes a long time to sort of see that, to sort of understand that. And again, most out there are caught up in the game of chasing profits, lacking discipline and risk theory. It's pretty much what we have been talking about here, and it's also important that you journal your trades, because if you don't journal your trades, you're not going to see what you're doing wrong, because here's the thing, right? It's impossible to know what you're doing wrong. If you lose money over and over again and you don't journal your trade, it's impossible. You're never going to know what you're doing wrong, because it's really hard when you're in there, when you're sitting there and you're taking trades to sort of see the dynamics. It's much easier if you have some kind of spreadsheet or a journal where you can sort of rely on, and you already have the data on these types of things. So right now we're gonna move into the live session here, and we're gonna sort of talk about these things that I've provided here, and hopefully it's gonna be a lot more clear when you actually see it on the charts as well. Alright guys, welcome to the live session. Now we're actually going to start applying all of the concepts and strategies that we've been talking about, and we're going to lay out a structure for the chart, and then as the video goes on, we're going to start to introduce more and more concepts, and after a while we're going to have some sort of deeper understanding of why the market is behaving in particular ways. And I've already mentioned some of the things that we can look for in the market, but there's going to be a lot of topics here, and there's going to be a lot of we're gonna sort of attack the market from different angles, and after a while you're gonna start to see why the market is acting in particular ways on in particular setups on the chart. So we're gonna look at the swing failure. We're going to start to look at how we can check the sentiment of the market, and also check for the energy levels of the trend, and sort of see when the trend is about to die out, and how we can use that in conjunction with a lot of technical approaches. But first, here in the beginning, as I showed you in the first session, we're going to lay out a structure that we can start to introduce these concepts on. So we can actually start doing that by now. So we are on the daily here on the perpetual swap contract on BitMEX. Just quickly, something to note about the perpetual swap contract is that it's actually an index from BTC USD backed platforms, and I believe it's from Kraken, Bitstamp and Coinbase Pro. So the price here, unlike from, for example, Bitfinex or Binance, which are tether backed and usually have a premium. So even though most of my trades, I'd say 90% of my trades happen on BitMEX, it's also very important to keep in mind how the Bitfinex and Binance charts is looking like, because sometimes even though Bitcoin, the Bitcoin market isn't always the same, or the charts sometimes doesn't line up, and sometimes they present different kinds of pictures of the market. So it's very important to sort of bounce back and forth between especially BitMEX and Bitfinex, to see sort of what's happening on both sides of the exchanges. But for now, I'm just gonna show you these things in BitMEX here, and we're only gonna go through Bitcoin in this session. But in the beginning here, we're just gonna keep it very basic, and we're just gonna structure the charts and sort of identify certain swing points that we want to target. And when the market reaches those areas, we want to sort of gain a confluence of factors to sort of run our trades more confidently on. So what I usually do is I start on the right side of the range, what I usually do is I split the range in half, and I try to work from the right side of the range to the left side of the range, because we always want to trade price action last. Price action last areas, meaning certain areas in the market where the price has yet to test. Those areas are for the most part going to be more, or the market is most likely to react to those areas more than if it's an old level from the left side of the range. So if we just split the range here, I would split the range down here, and I would sort of target this as the left side of the range. You could also split the range here, split the range somewhere in here, and sort of treat this as one part of the range. This is one part, so you have three parts like this of the range. So you have this, this, and this. Okay, but for now we're just gonna split the chart down here, and just the reason why we do that is because we want to target the latest price action in the market. So if I'm just gonna start mapping these areas out here, I'm just gonna target the swing points in the market like this, and just quickly map them out like this. Okay, so now I've sort of mapped out some kind of structure for where we want to see reactions out of the market. But again, this is very basic. These things are on the daily, so they are not something to trade by. They are more so to give us to sort of complement our hourly levels. Okay, so now that we have mapped these things out, we can start identifying supply and demand zones, for an example. And I do see, as I mentioned earlier in the video, we do have something up here. We also have a supply zone sitting here. We also have a supply zone sitting here. And I can tell that this is we have a demand zone sitting here, and I can tell it's a demand zone is that the market is sort of finding demand out of these areas in the market and sort of emerging, and this is sort of the base point from where the market did emerge from. Okay, so I'm just gonna continue mapping these things out here. Again, we also have something sitting down here. Okay, and we also have something sitting here. And of course there are more points in the market, but we just want to map out firstly, we just want to map out the most major supply and demand zones, and also price action last demand zones, meaning certain areas or certain zones where the market has yet to test again. Okay, and we have something in here as well. We might have something here, but I'm not gonna map them out because, for one, the market has already tested those areas. You can see here that the market sort of invalidated that area in the market, and it's showing to me that it's not as strong as, or it's sort of giving me a sign that this zone is not as strong as previously thought. So I'm just gonna leave that out of the market for now, because the market is going to be very messy soon, and you're gonna understand why I'm only targeting the most major things. But of course you can, for an example here, you can see that the market did have some kind of reaction out of this supply zone in the market, and the market came back up and we did find new supply, and then we moved higher. Okay, but I'm just gonna leave that out of the market for now, because we just want to be as basic as we can and just map out the most major things for now. Okay, something else we can look for is Fibonacci areas in the market. What I usually do is I try to look for fib clustering, and Fib clustering just means that there is a lot of Fibonacci areas lining up either on top of itself or in a closely stacked or squashed together area on the chart, and those areas are for the most part going to be more reactive when the market decides to approach them. I'm going to show you what I mean by that. So if I connect this swing point here, and I connect this swing point in the market, and I connect this swing point in the market, and I connect this swing in the market, okay? So now you can sort of see certain areas on the chart where these Fibonacci levels sort of line up together. So we can just map them out here. So we have something sitting here, for an example, and we can map them out in a different color. So let's make them blue, okay? We also have something sitting here, okay? And we also have something sitting here. We also have something sitting down here. So now I can kind of remove these Fibonacci tools from the market like this, and I'm left with these zones here, and you can sort of see that the market is reacting to these areas in the market. Again, it's not perfectly, but you see what I mean, that the market is kind of trading within these ranges or sort of reacting out of these ranges in the market, okay? So that's just a way that I like to use the Fibonacci retracements. Of course, you can use even larger swing points, and you can use the trend Fibonaccis and try to connect larger swing points or larger trend moves in the market and gain some sort of Fib cluster out of that as well. But for now, we're just going to use the basic Fib retracements and sort of find clusters here like we've done. And you can see that we have sort of mapped them out in the market here, okay? So we're just going to leave this as it is for now. Something else we can look for is we can try to identify certain support and resistance candles in the market. So here you can see that we had huge supply volume in this candle up here, and if the market decides to move back up here again, it's going to need an equal to or larger degree of demand in order to break this candle in the market. So we can sort of map this out here as well. So here we have some sort of resistance candle in the market, and we can also find, for example, here I'm just gonna map out the start of this candle here. You can see that it's kind of lining up here as well, and these are certain areas that the market has to have a lot of force in order to break. We also have something sitting here as well, okay? So I'm just gonna leave them in place as it is for now, and after a while you can sort of map out every candle. So we need to have some sort of structure where we only map out the most major ones in the market, because those are areas where the market is most likely going to react to, okay? So now we have some kind of structure here on the chart of certain areas that hopefully are going to be more reactionary than others, and it's a good starting point, at least on the daily here, for where we can get a bit more clear overview of why the market might be reacting or behaving in certain ways. But of course, the market isn't just behaving in these types of ways based off of these support and resistance levels or supply and demand zones. There's a lot else going into these types of moves. But again, this is just a structure, right, where we structure the chart, and we're gonna go back and look at the volume later. I just wanted to sort of show you these support and resistance areas in the market first before we move on, okay? Something else we can look for example, if I bring in the Ichimoku cloud here, you can sort of see here that we did move into the Ichimoku cloud here on the daily, and these are my own settings. I'm running the 2060, 120, 30. Of course, you can use the standard settings. There is no proven better way to use them. It's just preference, really. And you can sort of see that usually what I find is that the signal lines of the cloud or the Kumo is sort of acting as magnets for the market, where the market doesn't really like to trade or the market doesn't like to trade or churn within the cloud, and usually we see violent moves to the bottom or to the top signal. So when the market breaks a cloud like this on the daily, where it starts to sort of churn sideways, and it's not really a strong close within, usually the market likes to find its way out of the cloud. And you can sort of see what happened here, that we had a lot of space here to the topper icing, or to the top icing of the cloud, and it's much more easier for the market to sort of find its way down here if there isn't enough demand. If the demand isn't really met, usually the market likes to find its way to the bottom of the cloud like this. And you can see that it sort of happened here. We're still 1 hour away from the close here, and there's a lot of things that could happen, but I'm just saying that we are sort of targeting the lower signal line of the cloud here. So we have some sort of resistance sitting in this area for the market for now. Okay, so we can hide Ichimoku cloud because there is not too much going on the daily here on the Kumo, so we can hide the cloud for now. But again, now we have a mental note of that there is some sort of resistance here, and you can see that we have a fib cluster and a daily support level sitting here as well on top of the cloud. So we have 3 factors of confluence, for an example, on this area in the market. Okay, so that's just something to keep in mind. I'm going to remove the Ichimoku cloud for now. Something else we can look at, for example, I know a lot of traders like to use the moving average. Let's just check in with the 100 moving. We can check in with the 44, but there isn't too much going on in the 44, so we can maybe check in with the 100 as well to see if we can find something. And you can sort of see that the 100 moving average is sort of providing some sort of support to the market in this area as well. So now we have 4 factors of confluence sort of lining up here in the market, and you can see that the market is sort of struggling going lower here, or at least for now, at least the market has been sitting in this area for about, I'd say, 6 to 7 hours for now, not really doing anything, and it's sort of trading sideways on the lower time frames. Okay, so we have 5 or 4 factors of confluence here, but again, that doesn't really mean anything on its own, and it's important to understand that these factors of confluence don't have any true meaning on its own like this. Okay, even though they line up, it doesn't really tell us anything, because the market could easily move lower here or start reversing here, and we can't really tell based off of these indicators what the market is going to do. Okay, but of course we can sort of, if we have enough confidence on these types of trades, we can sort of guesstimate where the market is going to move. But more times than not, we just see a reaction out of these areas, and that's the best thing we can hope for. We can't really start saying that, well, just because we have a lot of confluencing factors sitting around here, that the market is going to reverse. All we can hope for is to see some sort of reaction out of the market, which we have kind of seen here. But again, we have 1 hour left on this daily close, on this daily bar here, and there's a lot more that could happen. But again, we're gonna check back on that later. For now, we're just building a structure here on the chart. Okay, something else we can look for is the VPVR. So if I just bring that in, you can see that the POC is sitting somewhere down here, and we have certain resistance or support areas in the VPVR as well. Okay, now what I mean by this is that if the market decides to come back down again, we have something sitting here as well, and we have something sitting here, and we have something sitting here. So if the market moves down, these areas tend to provide some sort of support for the market, and if the market tries to sort of move up, these areas tend to provide resistance for the market. Again, now we have sort of 5 or 6 factors of confluence sitting in this area, and you can see that the market is struggling to go lower from here, because there is again a lot of indicators, a lot of technical factors lining up in the market here. And of course there is a lot of traders that like to use different kinds of technical style of trading. So the more we have, the more people are gonna sort of trade these areas in the market. Okay, something else to look for here on the VPVR are these gaps here. usually when we have gaps in the VPVR, they tend to act as some sort of vacuum, where it gives the market a vacuum where the market can move resistance free without applying too much effort. And what I mean by this, if we start going to the chart here, you can see that these moves kind of started out of these gaps in the VPVR. And when we have a gap in the VPVR, it just means that those areas in the market haven't been, there isn't a lot of volume traded in those areas, and the market tend to move freely without applying too much effort through those areas. And when we see the market approaching these areas, we usually want to stay avoid of trading, because it's very dangerous to take a trade inside of certain of these types of zones in the market. And as you can see here, the market is moving really violently through these zones. Okay, again, it's just something to keep in mind. We don't really trade by these things on their own. We just look at them and we make some kind of mental note where we're saying like, okay, there is something here, and there is a lot of things lining up here, and we might the possibility of a reaction out of the market is going to be larger, and that's all we can do really. We can only improve our strike rates, because again, nothing is risk free, so we can't know for sure. Okay, so we can hide the VPVR for now. Something else we can look at is, for example, the Bollinger Bands. And usually what I try to look for in the Bollinger Bands are daily squeezes where the daily candle is sort of piercing through the Bollinger Band and then coming back down. And you can see here what happens when we see these kinds of moves in the Bollinger Band. You can see that the market is sort of reversing out of these areas when we see some sort of breaking pattern where the market is squeezing through the Bollinger Bands and then coming back down and closing below. And we usually see some kind of reversal out of these areas. But again, here we're kind of trading above the Bollinger Bands. There is nothing wrong with trading above the Bollinger Bands or under the Bollinger Bands. It just means that there is that the trend is pretty strong in these types of areas. Okay. You can see here that we traded all the way. This whole move was pretty much outside of the Bollinger Bands. So if the market decides to move, the Bollinger Bands is not gonna stop the market from moving higher or lower. Okay, but again, we try to look for certain things here. I'm just scanning the market here for certain possibilities, and that's all I can do really, for now at least, before we start looking at the more psychological patterns, such as the swing failure, where there is some kind of liquidity grab or some kind of stop hunt in the market, and we usually want to swing trade those stop hunts, because we are on the same side as the composite operator, pulling the invisible strings off the market. Okay, but for now we can hide the Bollinger Bands as well. Something else we can look at are certain types of indicators that shows either the energy of the market or some kind of exhaustion in the trend. Or if we look at the RSI, for example, we can see some kind of overbought or oversold conditions where the market is kind of running out of steam. So what I usually like to look at are the CCI, and I also like to look at the wave trend and as well as the RSI. So we can start with the CCI here, Commodity Channel Index. So what I usually do is, when we're running on the standard settings like this on the 20, I'd say most people run the 20 settings, but again, I don't really trade by these or use these signals on their own, so I want to filter out as much noise as I can. So me personally, I like to run with the 44 here. And again, this is just preference, and it's preference in my style of trading. I'm not saying that you should run with the 44. This is just some things that I look for and something that I've worked out on my own here. Okay. And usually what I map out the -200. I'm not going to explain the CCI, but how I tend to view the CCI is some sort of energy, trend energy, for when we're trading way above. For example, if we're trading above the 200 line, it means that the upthrust or the uptrend is sort of running out of energy or upward steam in the market, and we usually see some kind of reversal out of these areas. So what I mean by this is, if I just map out the 200 and -200 signal here, so if I just go here and I just map these things out, and I go to the -200 as well, something like this. It doesn't have to be absolutely perfect here. I'm just showing you these things. So let's say that we have the 0 somewhere in here as well. Okay. So when the market is trading above the 200 line, or in between the 200 to 100 or minus 100 to minus 200, there is usually something going on with the markets, and that the steam or energy is about to run out. So what I mean by this is, if I just map out the most major things I see here, so if I map this out here for an example, and I map out this down here, and for example I can map this out here as well. Now when we're looking here, when we see really violent moves in the market like this, it kind of it messes with the algorithm. I don't know the algorithm of the CCI or the wave trend, but when we see super violent moves in the market like this, it sort of messes with the algorithm, and it doesn't really become useful to us because it's not accurate anymore, because the market is moving way too volatile and there is way too much action happening for the indicators to sort of add up, or these are lagging indicators, and when the market gets completely overblown like this, where the market starts puking or starts going supernova, the indicators tend to not really tell the most accurate picture of the market. Okay, so this is some kind of anomaly. I don't really like to look at that, because you can see that we are way down here at the minus 500, and it's just insane, and it doesn't really tell us anything. So I'm just gonna leave that anomaly in the market like this as it is. We can, for example, we can look here at this peak and maybe look at these bottoms here, where we're trading in between the minus 100 minus 200, and as well we have something going on here as well. Okay, so let's just keep it very basic here and just look at these most obvious things, right? So here you can sort of see that the market is running out of energy on this upthrust. We don't really use these things on their own like this. I would have to look at the RSI and wave trend as well to sort of get a much more clear picture of what's actually going on here. Okay, we can sort of see that we did see a reversal out of this area in the market, and if I go up here, you can sort of see that this picked up the top pretty perfectly in the market, and you can see that we bottomed out here, we bottomed out here, we bottomed out here, and we bottomed out here as well. So you can sort of see what I mean when we're looking at these things here. Okay, but let's just look at the most obvious things. So you can see here that the market is sort of topping out up here, and the CCI is indicating to us that the market might be ready to reverse. Okay, but let's just focus on this last price action in the market here, because it was very obvious to me that the market was going to react, because everything was lining up perfectly. I'm gonna show you what I mean by this, and this was probably the safest trade I've ever taken trading Bitcoin. In my whole 2 years of day trading cryptocurrency, I would say that this trade here in particular was the most safest trade I've ever taken, because I was like 95% sure that the market was going to reverse here. Okay, I'm going to show you what I mean by that. I'm going to explain why I was so sure of the market reversing here. So we can also bring in the wave trend here. It's a super popular indicator, not so much in the crypto space, but I know a lot of forex traders use it. I like this indicator a lot here. And again, I'm not going to explain in depth what the wave trend is, but it just shows you when the trend is a bit overdone and it's about to reverse. So you can see here that on the wave trend we see the same type of topping pattern in the market, where it's sort of hitting the top signal and it's sort of coming back down again. Same goes for here. You can see that the wave trend is sort of bottoming out here before this small upthrust in the market. Again, here we have the anomaly again. It's really hard for the indicators, since it's a lagging indicator, to sort of catch up with the market. So I don't really like to look at these types of indicators in really volatile periods like this. Okay, and you can sort of see here as well that we didn't really hit the top signal here, but you can sort of see what I mean. When we're approaching the signal, it sort of indicates that you should be worried, or you should be more cautious of the market, especially in longing. When we're hitting the top signal like this, and I can go in here as well and just map this out here. So let's just look at the tops here, for example, and you can sort of see that it's pretty much perfectly telling us that the trend is about to reverse. Same for up here. And when these indicators line up like this, it's just going to give us more confidence that the trade is about to play out, or that the market is about to reverse, because it's running out of steam or energy in the markets. Okay. But let's just focus on this last price action here, because it was really interesting watching this happening live, because I could see it miles before it even happened. And I think that there was a lot of traders caught off guard here, especially just looking at the Twitter sentiment. There was a lot of bullish people, and as well as just checking the sentiments in Slack and Telegram and TradingView. You can sort of gain just by spending a couple of minutes or maybe an hour or so just scouting social media. You can sort of gain some kind of sentiment check on where most traders are, what most traders are sort of thinking, right? And I saw a lot of bullish price action here, or a lot of bullish sentiment, in the markets here, where there was a lot of people thinking that the market was going to make some kind of approach to the 4.8k or even 6k area or 5k area. But to me, this was a very, very obvious trade, or a very, very obvious short opportunity. And I'm going to go more in depth, but right now we just mapped out the structure here. I'm just going through the sentiment with you here, and later on we're going to look at the chart itself at this point in the market, and why this was such a safe trade to take. Okay, so we can as well bring in the RSI here, for an example, to check overbought or oversold conditions. And you can sort of see here that on the RSI as well, on the daily, the market is a bit overbought here, and demand is starting to run out of the market. And these other wave indicators and this wave indicator and the CCI is sort of telling us the same picture, that the market is running out of energy and the trend is about to reverse soon. And when I see these things lining up, I want to look at the chart, especially in this point on the lower time frames, to sort of look for an entry in the market and look for certain patterns. For example, if I have any price action pattern, if I have any candlestick pattern, I want to sort of identify that, because the more confidence I can have, the more I can improve the percentage rate of my strike rate that the trade is going to play out into my direction that I want the market to move in. So now you can sort of see here that certain things are lining up. We can also check the open interests to see the overall sentiment of longs versus short ratios. So I just bring this up here. Again, this is on Bitfinex, but again, it's pretty much the same across all platforms. It's pretty much the same across all future platforms. Okay, so you can see here as well that the shorts are at its lowest rate. Okay. So what does this tell us? Well, it tells us the market is overdone. There is no energy in this upthrust left. The trend is about to reverse, or it's giving us some kind of signal that the market is about to reverse. We're also in a supply zone. We have also some kind of swing failure on the daily. On the 4-hourly as well, we have a spinning doji in the market, and it's not in traffic. Okay, so we have all of these things together, and we can sort of map out the picture here of the market, like what is going on here, what's most likely going to happen. Okay, so you can see that there is nobody shorting the market here. And when nobody is shorting the market, especially in an uptrust, what does that tell you? Well, it tells you that if the market goes down, there is nobody going to make profits. Okay, and if nobody's making profits, the market usually likes to head in that direction where there is the least people possible making profits. And usually when the shorting is at its lowest point, there is usually either is a lot of people sitting on the sidelines, or there's a lot of people longing the markets. Okay, and it sort of goes hand in hand with the sentiment check I did on social media, because everybody was bullish and there was nobody shorting the markets. And this pretty much just confirms that picture where there's a lot of people who got stopped out in this move. And I think there was a lot of people who lost a lot of money trading this here, because when people see these types of moves, we have been in a long downtrend. People are sort of hoping that this is going to be it, that they're going to catch the bottom, of the market, and I'm not saying that the market is going to collapse from here. I'm just saying that this move here, or this candle here, happened very naturally out of the markets, and there's a lot of confusion and anger that is sort of capitalizing on here, whereas a lot of traders was caught off guard or put offside in this move here. Okay, and we can sort of look at the short ratios as well here. So when the short ratios are approaching low points like this, it usually signals to us either if open interests are rising with the trend, it usually means that there is some kind of trend continuation, and when the open interests are dropping with the trend, it usually means that there is some kind of trend reversal about to happen. Okay, so let's just identify the low points for now. So we have a low point here. We have a low point here. And we also had something happening here. And we also had a low point here, kind of. Okay. And it's also important to keep in mind these climax points here on the short ratio, because they sort of play in to the same direction. So here you can see that if you remember the chart, we were in a sharp uptrend here, and everybody's so hopeful and everybody's feeling some kind of euphoria. The market is going to move higher, and everything is just telling us that the market is going to reverse here. There is nobody shorting the market up here, meaning that there is not going to be a lot of people making profits on the way down. Okay, and usually, as I said before, when there is no shorting in the market, there's usually some kind of overstacking of long liquidity, where there's a lot of longing going on, especially on these climax points in the market, where the market has gone supernova, and there's a lot of people feeling hopeful that the market is going to go higher. And usually when we reach those points of euphoria, the market tends to reverse and sort of destroy everybody's dream in a way. And you can see the same here, where the short ratio is sort of bottoming out in this uptrend here, and there's less and less shorting, and we reach this small junction here, and the market sort of falls out of this here until the market picks up shorting again, and we reach some new climax point. And it's also important to sort of compare the short ratios to the ranging areas within, so you don't go off to the sides and start looking over here and saying that, well, there isn't a lot of shorting, because you have to put it into the context of the market as well. So you can see here that compared to this area, this is some kind of climax point compared to the previous low points in the short ratios. And you can see that the market sort of reversed as soon as people started shorting the bottom. Okay, and we can use all of these indicators in conjunction to sort of gain a more clear picture of what's actually going on. Now, even though we have all of these things lined up like this, we still do not trade based off these things. Okay, I don't go into the market and just slam a market order and saying that, well, everything is lining up here, I'm gonna short the market. Okay, even though it would, it would most likely, for the most part, I think it would work out for me, especially when things line up like crazy like this and everything is just screaming reversal in the market. Even then, I don't trade based off these things. Okay, because I have seen these things line up before. Not especially on Bitcoin, but in other markets where things line up and the market just keeps going and going and going. It's not a foolproof trade, but for the most part, I'd say that the strike rate is way above the 50% mark on these types of trades. Okay. So if I just hide everything here, so now we know. Okay, so just keep a mental note of all of this. So I'm just gonna remove everything here again, because now we have sort of mapped these things out in our minds, and we have some side. We know. We have some type of picture of what's going on in the markets here. So we're now approaching this area here, and if I go back to the concept again, I always want to trade the last swing point in the market. Okay, what I mean by this is, well, when the market is coming up here again, I want to target this swing point here. Okay, I want to see a reaction out of this swing point. It's not necessary that the market reacts, because you could see here, for an example, or here, for an example, where the market shot straight through and completely ignored these swing points in the market, and there was nothing for me to trade by, and I was just sitting there kind of offside and just waiting for something to happen. And of course, I already knew that we were approaching sort of a problem area in the market, and I was just patiently waiting for us to reach this area. And when we reach this euphoric point in the market, that's when you want to start looking to sort of counter trend the masses. Okay, So when the market came up here, I was staying patient, I had discipline, and when we reached this point, I started looking, right? I was really focused here because I knew something was about to happen, okay? And I know I'm sugar picking this, I already have the answers, but trust me when I say this, I already knew this was gonna happen, okay? I was not 100% sure, but I'd say I was 90 to 95% sure this was going to happen, okay? And I haven't even showed you yet why. I've showed you the technical side of why I thought it was gonna happen, but I have not really showed you the more psychological part of this happening, okay? And that's why we have these tails here, okay? So as you remember previously when we talked about the swing failures in the market, this is what I mean, okay? Like what is happening up here? Why did we see these tails up here? Okay, so if you remember the paint schematic I did where I showed some basics of the swing failure, this is pretty much what I'm looking for in the markets, and especially when the technical side start lining up with these things. Okay, so we have a swing failure here on the daily. Okay, now this is not a perfect swing failure, okay, because when we move to the lower time frames, you're gonna see that the market is sort of churning on this area. Okay, it's not a quick and easy swing failure where the market comes back down and then moves lower. We come up here and we start churning for a while, and then the market moves lower like this, okay, on the lower time frames. Okay, so I would call that some kind of extended swing failure where the market is churning on a swing point, okay, but it's not a perfect swing failure. But on the daily here, it looks kind of good. You know, we came back first time and then for the second time, and then the market moved lower. Okay, so I was targeting this swing point in the market because this is price action last, and I want to see some kind of reaction, and we're also sitting in this huge supply box where demand really has to come in and show itself. Okay, now I'm not saying that, you know, we have an established uptrend here, okay, because we made it's not a perfect uptrend, but we did make for the uptrend to be sort of valid, we would need to have some sort of swing above this move that took us down here. So if you imagine this, if you just look at this without looking at Elliott wave analysis, if we just look at this in waves, so this would be wave 1, this is wave 2, and for this uptrend to be maintained, we would need to take out wave 1, right? Because we need to make higher highs and higher lows for an uptrend to be valid. But in this case, we kind of failed, and we didn't maintain this uptrend in the market. Okay, so I would need to see some close or a swing that's taking out wave 1, otherwise wave 3 is not going to be valid. I'm not saying that the market is going to start moving lower here. The market could start churning sideways or churning down, and we get some sort of 50% test of this upthrust and then moving higher again. Okay, but I'm just saying that for this move to continue upwards, we need to see a breaking of wave 1 in this upthrust in the market. Okay, but having that said, we did see a higher low here in the market, okay? So that's something I'm looking for as well. Because we always want to trade with the trend for the most part, but this is not really an established trend since we didn't make a higher high, okay? For now at least. So when the market is coming here, I want to see some type of reaction out of this swing point in the market, and I got my swing failure here. In this case, I did see a swing failure in the market. Okay, and this swing failure is on the daily, and we don't trade on the daily levels. We don't trade on anything daily because we are swing traders on the lower time frames. Okay, so I'm going to the lower time frame. So in this case, I'm moving to the 4 hourly. So I move from the daily to the 4 hourly, and then I take my trade on the hourly. Okay, so if I move this, I can actually go in here and I can sort of identify. And here, what you can see what I mean here, that we have a sort of a spinning top or a doji that's not in traffic. And what I mean by it's not in traffic, well, you see we have a lot of different kind of doji patterns here. They are playing out sort of. We have a hammer, here we have some sort of hangman, and you know, they are sort of playing out. But for example, this here, let's say that it's an inverted hammer, okay, and it's happening in traffic, meaning that it's sort of happening in a sideways manner, okay? We want to see topping actions when we're looking at these types of candlesticks. So this is a spinning doji. This is a spinning top or some kind of doji that's not in traffic. okay? It's not in traffic, and it's indicating to us that there is a lot of confusion in this area, okay? There's confusion going on here, because when we break this swing in the market, we usually want to see something violent like this, where we just completely break the area and move to the next area, okay? But when the market starts churning like this, I'm gonna stay more cautious. And again, I could have taken this trade here because we did see a swing failure of this swing, of this previous swing high here, where we come up here and we come back down. So what I could have done, I could have just taken the trade here and then, and I would have been stopped out on this move here, okay? But even though I would have been stopped out, I can still re-enter the market. So it's not like I'm completely out of the markets. I can start scouting again and scavenging for information to take the same trade again, okay? So even though we do sometimes get stopped out out of the swing failures like this, because I can't really know if the market is going to move lower here, okay? But in this case, on the 4 hourly, I have this doji pattern that there is indicating some kind of confusion to me. And especially when the market comes back down like this, okay? When we see a red bar like this on the 4 hourly, in conjunction with this doji pattern here, in conjunction with all of the other things I've showed you, I'm now very, very certain about this trade, okay? Because it's way too much indicating that the factors are sort of lining up too perfectly for me to not take this trade, okay? But again, there's nothing too much going on the 4 hourly here, so if I move to the hourly, and I move in here, well, for one, it's not perfect, but I see something else here. I kind of see a head and shoulders like this. Again, it's not perfect. I can admit that it's not perfect, and it's not something to trade by, but again, it's sort of there, and it's sort of providing some kind of head and shoulder structure for us, okay? I'm just going to remove that because it's not perfect, and we don't really want to look at wish-washy patterns or indicators like that, okay? So what I did here, I entered a trade here. When we came back to the icing like this, I entered a trade here, okay? And I would have my stop loss sitting up here again, okay? So I put my stop loss on this last swing in the market, and usually the market doesn't swing against us twice. Usually this doesn't happen. And especially when we have a lot of confluencing factors on the high time frames telling us that it is about to reverse somewhere in here, okay? And in this case, this trade did play out, and I'd say for the most part, this particular trade would have played out in almost most cases, okay? So I enter here, I have my stop loss sitting way up here. Something else that you could do, if you use some kind of volatility-based stop, I usually check in with the average true range, and I usually run with the 24 pip average true range. So in this case here on this trade, I would use a 23 pip based stop, meaning that I would, from my entry, I would move my stop 23 pips above. So let's say that this is on, so this is at 30, so I would move this to 52, or so I would move this to 53. So if I just move this to 53 here, okay, my stop would be sitting slightly above this outside bar here, but what I would do is I would just add a bit of padding. If I used, in this case I wouldn't use an ATR, I'm just showing you here different kinds of stop mechanics that you can use. You can also trail it with thrust bars or outside bars in the market, which in this case I did. I'm going to show you what I did on this particular trade here. Okay, but that's just something I can use. In this case I wouldn't use it because I'm not really risking too much by putting my stop up here. So in this case I would be risking 1.5%, which is nothing really, okay? And I'm putting a bit of padding on my stop, but I'm placing it above the last swing high on the hourly, okay? And I entered somewhere here. Now this is not a perfect swing failure, but on the daily we have a swing failure, okay? It's important to remember that on the daily we have a swing failure, okay? But it's not really lining up with the lower time frames. So I would say that this is an extended swing failure where it's sort of churning sideways on the level like this, and especially when we have all of these other confluencing factors lining up. I'm very confident in this trade by now, okay? So when I see that the market moves lower here, what I do is as this is not a large trust bar in the market, so I would still keep my stop loss up here, because sometimes we see something like this where the market comes down and then it comes back up for a second time, and usually it doesn't take out the first swing in the market, or the first swing high in the market, or the first squeeze in the market, or the most major squeeze in the market. The most major squeeze in the market. We usually doesn't see that happen. It happens, and if it happens, we can just re-enter the trade again. If we're really certain that the trade is gonna play out, and we have some sort of higher time frame directional bias on our trade, and we're really certain it's gonna play out, we're not really revenge trading. We're just looking for a new entry into the market again. Okay, so it's nothing wrong with being stopped out, because it happens from time to time. Okay, but in this case, it didn't happen. Okay, and it's not really, there's nothing for me to move my stop here to, because I could move my stop here and I would just get stopped out like this, and then we see a move lower. So we just keep my stop loss up here for now until I see something, until I see a large move in the market. Okay. Okay, so we're looking like this still. I have my entry up here, and when I see this happen, when I see the market going like this, I'm immediately moving my stop loss up here. Okay, now I have secured a bit of profits. All right. So on this trade, I've already made 1.13%, and the likelihood of the market starting to reverse when we see completely insane puking action like this is almost zero. Okay, so I'm just locking in 1% here, and the likelihood of the market coming back up and sort of taking me out here is extremely low. Okay, and sometimes we see something like this, where we see something like this, and then something like this, and then something like this. And in this case, I would just trail my stop here, and when this closed down here, I would trail my stop here and trail my stop here, and I would trail it sort of with the downtrend until I reach my profits, and until I reach my profit area in the market. Okay. Now, where would I take profits in this? Well, I don't know if the market is going to reverse on me here. It could come back up and we start ranging like this, or it could come back up here and we see some sort of bounce short happening, where the market then moves lower again. But again, I don't know where the market is gonna move here. At this point, I'm already out of my trade, by the way. I'm not in this trade anymore. I made more than enough profits on this trade. There is no reason for me to sit in this anymore, because if the market comes back up again, I can try to find a re-entry. Okay, I can try to re-enter on a short position here. Okay, so in this case, I'm not looking at this range here. Okay, there's a couple of areas I want to look at. For the first part, or first of all, we have formed some kind of range here. Okay, we have a swing high in the range here, and we have a swing low in the range here. Okay, so when I see the market moving really violently like this, I tend to not take profits, and I would quickly try to pull my sort of my profit stop, or my profit target, sorry. And I want to target the icing, the bottom icing of the range. Okay, or I want to target the last inverse level in the market. Okay, and what I mean by inverse level in this case, this would have been the inverse level. Okay, because now the market is sort of pivoting from being from showing resistance into showing support again. So if we would see some puking action like this, and the market sort of stops here and then moves higher again, I would tend to target this area. But when I see violent moves like this, and I have huge directional bias on the higher time frames, there is no way I'm taking profits here. There is no way I'm gonna take profits at the first potential reversal point or reactionary point in the market. Okay, so what I try to do is I try to target the bottom range here, because we have a range here, and I want to target the bottom here again. Okay, because I am a swing trader, I'm not a position trader. If I were a position trader, I would just short here and I would wait for 3K to happen again. Okay, but that's not how I trade, and I don't know if the market is gonna come back up here again. And if the market comes back here again, well, I've already given back half of my profits. It's better to take profit into weakness. Sorry, it's better to take profits on a short position into weakness, and it's better to take profits on a long position into strength, because you can't foreshadow anything, and it's really easy. If you take profits too early, it's really easy to sort of beat yourself up over that if the market starts going lower and lower. But you can't know. You can never know, especially when you're trading cryptocurrencies. It's extremely volatile. And sorry, the market moves extremely volatile. So you can't really know when to take profits, or you sort of have to systematize a way for doing it, okay? So in this case, I took all my profits at this level here, okay? And I know there's a lot of you that's saying, well, that's so stupid, why would you take profits there? The market is going to move way lower. We have all of this directional bias. You could have run your trade even further. You could have targeted areas down here. You could have started looking at this range down here. The market is for sure going to move lower. Well, if I did that, in the end, I'm most likely going to lose money, okay? Because I'm not disciplined. I'm sort of hoping that the market is going to move lower, okay? I'm hoping that it's not going to reverse here. Okay. Now what I could have done here, well, I could have entered on a long position here and sort of tried to play this up again here. Okay. I'm not done that. I'm filming this video now, and this is very, this happened today. Okay, this happened today, so I'm still trying to process this in the same way that you're processing this right now. I don't know what's going to happen, but I know that we have a swing failure here on the daily as well now. So the likelihood of the market moving higher, just based off that swing failure, is, it's pushing the strike rate a bit to bullishness, in my opinion, just based off these things. We take out this last swing point here in the market, okay? This is the swing I'm targeting now. And of course, I could have tried running my trade all the way down here, okay? But in this case, I'm sitting offside of the markets for a while now. I just want to get into the markets again and start trading again, okay? But I could have easily tried to sort of run my level to the next sort of inverse level in the market, okay? And this would have been the second inverse last, okay? So I could have tried running my trade down here and then switching from or sort of hedging my position into a long position down here, okay? But in this case, I don't know. I honestly can't remember if I took profits here or if I took profits here, but it was somewhere in this range, okay? So what would my R be on this trade? Okay, so I entered up here. I had my stop sitting here, and I'm completely fine with losing 1.7%. I'm completely fine with that. If it happens, it happens. Okay, there is no reason to be bummed out or feel some kind of shame that, oh, I should have held that trade, because more times than not, the market is just gonna move on you, and you're just gonna sit there, and you're, for the most part, just gonna be angry that you didn't have any discipline. Okay, and in this case, I made about 7% on this trade. Okay, so I made about 7% on this trade, and it was the safest trade I've ever made trading cryptocurrency. Maybe not the safest trade, but for a while here, over the past couple of months, this was easily one of my best setups in the market. And I've scalped the markets, even though I make 7% on a move like this, sometimes I scalp smaller moves in the market and make 7%. Okay? I'm not really happy, I'm not really sad, I don't really feel anything of this move. It happened, I move on, I try to look for another opportunity in the market, okay? I move on quickly, because I could have lost, okay, I couldn't have lost 7%, because that would not be a smart move of me to risk that much, especially on a swing trade on the intraday. But you sort of see my point here, okay? Now what I could have done, I could have entered here, and I could have had my stop loss sitting somewhere down here, okay? And I would have sort of tried to target this market, or tried to target this area up here. And we're approaching the close here in 15 minutes, and I don't know what's gonna happen, okay? I've seen the swing failure here, and we can sort of watch this together now and sort of see what's happening. All I'm saying is that if I entered on the icing here, and I'm trying to look for the sort of a retest of this range, where we retest the bottom icing here, and it's important to understand that these swing failures, sometimes they line up with other technical stuff in the market, okay? So in this case here, if I did enter, I re-entered on a long position down here again, I would have my stop sitting maybe down here.
and I would enter here. I could also take profits if I move back to the daily here again. You know, I could have played this and taken profits up here. Okay? I could have just played this. I see the swing failure happening on the lower time frames. I move in on the 4 hourly or on the hourly, and I try to target this up here. And on this trade I would have probably made like 1 or 2%. I would make 1.5% on this trade. And it wouldn't be that, you know, it wouldn't be that, it's not that hard of a trade to make, because it's very simple. These concepts are very, very simple. There's nothing else going on here. You know, either we take the liquidity or we don't. And if we take the liquidity, the possibility of the market moving or sort of reversing into that direction is a bit higher. Is the market going to move lower here? Well, I don't know. I don't care. I don't care if the market moves lower. I get stopped out, fine. For the most part, I don't get stopped out because I know what I'm doing. I know what I'm looking for in the markets. Okay? And again, on the 4 hourly here, I can start introducing these indicators again to start looking for more confluencing factors. Okay? So if I bring in the smoky cloud here on the 4 hourly, okay, you can sort of see that I'm like trading against, I'm trading with Ichimoku cloud here as well. Okay, because I'm sort of hoping that the market is going to find some support here. We also have a fib cluster sitting here in between these two daily zones, in between these two daily levels. Of course the market can come back down here and test the bottomizing, but in this case I would have entered here and I would take profit up here again. I would have made like 1.4% on this trade. I would already be out. I made 8% today on the intraday on swing trading. Okay, I'm just showing you some of the things here, okay? I'm just showing you examples here of how you can do these things. There's millions of other ways you can do this, okay? I'm just using some of the indicators. You know, you might use the MACD or whatever, you know, you can use whatever. Candlestick patterns, price action patterns, triangle patterns, Wyckoff patterns. If you're a Wyckoff trader, you already know about the spring effect in the market. You know about distribution and accumulation phases in the market. You can implement that into the swing failure, into gaining confluence, okay? And you don't have to sort of, you need to be patient for these setups to sort of play out, okay? It's completely fine to sit a couple of days on the offside and not trading and just watching the markets. It's okay to sit a week with not doing anything, you know? And if you start to sort of ease your way back in, just start small in the beginning, just work your way in to these types of setups, okay? It's 9 minutes left of the daily close here. And you can see that we have a swing failure of the swing point here. Now, if the market, if we get a close here above the swing failure, above this swing point in the market, I mean, I could potentially try to enter that trade and sort of play that trade. I could put my stop down here and sort of play this up here again. Okay? I might pause the video here and sort of analyze if I missed something or, you know, if I'm not explained something perfectly. And you can see that the market is sort of reversing. It's 8 minutes left, and usually we see kind of violent moves before the closings, especially on the 4 hourly, 1 hourly, and daily like this. And we also have a weekly close today, so we can check in with the weekly as well, because it is Sunday. Okay, so the weekly isn't looking good, I can tell you that much. The weekly is looking kind of horrible, to be honest with you. but again, it's not, you know, the market could reverse. We don't know. We can't just say that, oh, the weekly is looking terrible, I'm gonna stay void. No, we have to look at everything in conjunction and look at these factors, okay? I hope I made myself clear here. And again, this is just one example, but I might make more videos on more setups, maybe live stream when I do these trades in action, so you don't see that I'm just saying these things, that I'm actually trading, okay? So for now, I'm just gonna pause the video here. We are approaching the 1 hour mark, and I might take a trade here actually, just to show you, and maybe I get stopped out, maybe I don't, and I guess we'll have to see. So I might be back with you in a couple of hours again and see what happened, okay?
Alright, so I hope that this was clear enough. I'm gonna go through everything and see if I missed something. Of course, there's a lot of other things in the market. You know, there's a lot of other concepts, theories you can trade by, but these are some things that I look for the most part. Of course, there's other things as well, and you sort of have it's very important that you have a all-knowing understanding of all things in the market, okay? So I'm just gonna pause the video here, and I might be back later, okay? So if not, I guess I got stopped out, and I'm fine with that, and yeah. Okay guys, I'm back now. For me it's been 2 days, but for you it's been just a couple of seconds. I didn't have any time to film anything yesterday, so I'm filming this last part here just to fill you in on this trade that we were talking about. I've actually gone through the video as well to look for if I missed something that I wanted to cover, and there's a couple of things that I missed on, and I'm just gonna quickly cover them in here. So as you can remember, we were talking about maybe entering the trade down here, and when I paused the video I actually entered the trade here, actually right here on the close of this red candle here in the market, and we are on the hourly here, by the way. And so let me just restate or reinforce that setup that we were looking at. So we had a swing point sitting here that we were targeting, and you can sort of see that we did see a swing failure here, and this happened on the daily as well, and it's looking like this on the daily, where we did have a swing point. And if I go back on the 4 hourly here, you can see that we did get a swing point here in the market, just as I showed you previously. And we also had a couple of target areas. So we actually had something sitting up here as well, and we had this one mapped out, but I believe it was this here mapped out. So these were sort of my target points for this trade, somewhere in between here, and you can sort of see that we did get a close right in between these areas here. And in this particular trade I did take all my profits at the first target area here, and I did get I'm gonna show you here that on the hourly here. So I took my profits here, right here on the icing of this trade here, and I was quite happy when I saw the market reversing, but then immediately the market came back up, and I was like, I should have waited. I thought to myself, I should have waited and I should have taken profits up here. But I was not really bummed out about it. It was completely fine. But you can see here that the market, you know, there was probably a lot of other guys that had the same idea in mind of taking profits here. And sometimes you get front run in the market like this, and it doesn't quite reach the area that you're targeting in the market. And why you get front run? Well, it can depend on a couple factors, and we're gonna start looking at some of the factors that I actually missed on here, because we did actually have a lot of confluencing factors sitting down here as well. I did show you the Ichimoku cloud, but there is actually a lot more than meets the eye at this area as well, and there's a lot more than just a swing failure on the 4 hourly and the daily like this. Okay, so we can actually start bringing in some things here. Again, so we can start looking at the Ichimoku cloud where we left off, for an example. So if I just bring that in, so on the 4 hourly, sorry, on the hourly, I don't really like looking at the Ichimoku cloud on the hourly, but you can sort of see that it is finding support here, and down here it's just churning a bit. But if I go to the 4 hourly, that's usually the lowest I go when I look at the Ichimoku cloud, and you can sort of see here that we did get a sort of a weak close in between here, but the market came back up and we did find resistance here, and we kind of find resistance here as well. But now we're sort of trading, we're churning into the cloud like this. Usually when the market churns into a cloud like this, it usually drops or starts moving, because again, as we were talking briefly about the Ichimoku cloud in the live session, the price doesn't like trading within the cloud like this. So either we move quickly out of it, or the signal lines act as sort of magnets for the market. Something else I didn't show you in the Ichimoku cloud, we have the Tikin Sen and Kijun Sen, and the baseline and the conversion line. I use these as well, but I figured that I removed them for now because it's a bit more, they are a bit complicated to talk about, and I would need a lot of time to explain these things. But they do work as support and resistance areas for the market. And something to note about these Kijun-sen and Tenkan-sen is that they can actually stop moving trends. So when the market just falls like this on the daily, and we have the Tenkan-sen sitting here for an example, the market is going to make a pause here before moving lower. It doesn't have to reverse out of these areas, but it's just, I know I've never seen the market not react to the Tenkan-sen or Kijun-sen. Okay, the market always reacts. Always. Okay, we always see a reaction from those support and resistance factors in the Ichimoku cloud setup like this. But for now, I'm just gonna leave them out of this for now. So we have some kind of support here on the Ichimoku cloud as well. Again, it's not really perfect, and you could move to the standard settings as well. We can actually check if I'm not checked in with the standard settings, but we can check if there is something there. So if I just change this back here, and we can sort of see, you could see that the market did find some kind of support, some kind of resistance here. And this is what I mean. Sometimes you have something like this sitting here, and you're really bummed out that the market didn't really reach your target icing, or that you had your trade or sort of your target at the icing of a level like this. Sometimes we have factors here in the market that is sort of shielding the price from moving higher, and it's easy to get front run because there is a lot of Ichimoku cloud traders, and there is a lot of trading bots that are using the Ichimoku cloud algorithm to trade by, and it's easy to get front run by obvious areas in the market like this. Okay, but in my case, I did take my profits here on the first part, and I did get quite a bit of bummed out when I saw the market moving, and I thought to myself, maybe I should have waited. But you see that it kind of did pay out. Sometimes it pays out, sometimes you lose a bit of profits, but that's just the game, and you can't foreshadow anything in the markets. At least nothing is risk free in the markets like this. So we can sort of remove the Ichimoku cloud because we can keep that as a mental note as well. Something else I didn't talk about in this range here, we have actually formed a channel here that the market is trading within. So if I just map these 2 points out, you can sort of see that the market is finding some diag resistance here, same as up here. If I just map these out, and this is the anomaly of the market. Again, we usually see something like this. This is a swing failure on a diagonal line. This happens quite a lot, especially on the high time frames. If we go back to the absolute beginning of the video, if we have, let's say we have a daily period like this where the market is trading like this and then falls out like this, and we could actually be in that falling out phase of the market on the daily here. And what I mean by this is, so let's say that we have a huge like a wedge like this. So let's say that. So just quickly here, let's just pretend that we have a descending triangle like this. Again, it's not perfect, but I'm just showing you, and this could be sort of something like this happening in the market, where this is a huge shakeout before moving higher again. Okay, and of course this is just a quick example, and I'm not put any thought or depth into this. I just want to show you sort of, and I know this happens within. I've seen this happening all over the place within here, because I've actually traded this whole downtrend here. Okay, I have traded every move you see in this downtrend. I've watched the charts, I watched Bitcoin. There hasn't been a day where I haven't watched Bitcoin over the past couple of years. Okay, I know every move in this market here, and I see this happening a lot, especially if I go back to the 4 hour here. Especially these things. Okay, I don't know what to call them really. It's just the market sort of fakes out like this and then comes back in, and it happens quite a lot on Bitcoin, especially Bitcoin and other large caps in the market. Okay, but that's just something, I don't really know if this is a pattern or what to call this really. It's just something that I've made a note out of trading these of trading cryptocurrencies, and I know this happens on a lot of markets, but I can only speak from the crypto markets because that's where my experience lies within. So you can sort of see here that we're trading within this channel, and we also have a swing failure into a channel, into this defense here of the channel where the CM is protecting. He's selling in to the channel signal line here, and he starts defending the market on the icing into the swing failure. So you sort of see here that we have that the market is sort of, there's two factors here, just based off the swing failure and based off the diagonal resistance in the market, the diagonal support in the market. And these sort of play hand in hand here in this trade. Okay, so I just want to show you that quickly before we move on. Now something else to look for here. So as stated, I did enter on the close of this red candle here, and I did have my stop loss sitting slightly below this squeeze point here in the market. So if the market came back down here and squeezed me out, I mean, I would be completely fine with that. So let's just check what my triple R would be on this trade here. So long position, I entered here, I took profits up here, and my stop was sitting here. So in this case I had a 2.2 R. I was risking about 1.1% to make 2.6%, and again I made 2.6% on this trade here, and as I explained earlier, I made about 7% on this move here. So all in all, I've made almost 10% here over a period of a couple of days. And you know, making 10% on your capital over a period of a couple of days, and when these things start playing out more and more and more, and you start learning these concepts, they do add up quite a bit. So it's just something to keep in mind, because sometimes people get sort of turned off, especially the crypto folks. If you only make like 1%, they don't really quite understand how to trade really. Most crypto traders are not really traders, they are more gamblers, or they don't really have a strategy or anything like that. But there are good people out there for sure. It's just that there is a lot of noise, so to say, in the crypto space, and it's important to filter out those people, filter out the noise as much as you can. And you also need, you can't just filter out the noise without having experience of your own, because you can sort of after a while tell who is legit and who is just a con man basically. Okay, but in this case I did make 2.6% here, and you can see the market moved higher here again, but how would I have known? It's just something that you have to live with, and I did take profit into strength like this, which is something that we always want to do. So something else that we can look at, if I bring in the Bollinger Bands, and we can like talk about the indicators that we used previously and not start mixing up or bringing in new indicators. So you can sort of see here that we do have a breaking here where the market, where we see these tails breaking out of the Bollinger Bands on the 4-hour like this as well. So it's again something to look for, and we also had a huge squeeze here in the market that I didn't see earlier when we moved up here. But again, it's just something to look at. I usually just look at the breaking patterns and the squeezes in the Bollinger Bands. There's nothing too much going on, or at least not something that I look for at least. Something else we can bring in is maybe the moving average. I don't think it's gonna support anything. We have the 20 sitting up here, and again the 44 not really providing anything either, and I don't think the 100 is going to do so either. Maybe, at least, yeah, we did have some kind of support here as well on this diagonal icing here by the 100 moving average. So again, it's just something to look at. Again, I don't really use the moving averages too much, but it's just something to look at, I guess. Something else that I noticed, if I bring in the RSI here again, we actually have two types of divergence here. First of all, that I didn't really quite get, or that I didn't really see here, is that we have on this trade here, I did also have a bearish H4 divergence here on the RSI. As you can see, it's quite clear here. The market is not acting natural up here whatsoever, and this, you can see that on the RSI that it's not really behaving in a natural way like this, and there is some kind of anomaly here as well. So that's something else that could have played into my trade. But again, you can see, as I mentioned, there is a million types of things you can look at, and you sort of have to find what works for you, and sort of test a lot of things, and sort of gain a database of your own on these types of things, so you can sort of rely on them in future, or in future opportunities that's going to present itself. So that's also something to keep in mind. Something else that I see on the RSI is that we also have hidden bullish divergence here. And you can see that I'm not going to talk about what hidden bullish divergence means, but you just have to trust me here. You can look it up yourself. We have hidden bullish divergence here as well, where this low point is trading above this low point, and this low point or this low point is way up above this low point here. So there is we also have hidden bullish divergence here, and again, it's just kind of playing in with this taking this long here. But again, all of these things stem out of the swing failure. Okay, so we have the swing failure, and now I'm looking. Okay, we have the swing failure, we have the swing failure, and now I'm looking. Okay, now I'm scouting the markets for certain things. Okay, so that's also something to look at, right? So if I hide this now, and we can go back here to the price. Something else to look for. So you can see here that when I entered here, we have a candlestick pattern here. So this is an engulfing candlestick, okay? Because it's engulfing the body of the last bearish bar. So this is a bullish engulfing candle on the H4 as well. Okay, so this is just indicating that there is some kind of reversal in the makings when we see something like this in the market. Okay, so this sort of played into the trade as well. So if I just map everything out here, we did have H4 engulf. We also did have H4 Kumo support. We also had 100 MA channel diag. We had D1 SF, D1 slash H4 slash H1 SF. We also have Bollinger Band break on the H4. We have we have hidden H4 bull div on RSI. I might have missed something here, but you can sort of see here that we are sort of stacking up these factors together on this trade that is going to play out into our favor. And as I showed you, I did run the trade up here and I took profits there, and now I'm sort of waiting. Again, I don't really know what's gonna happen here. We're trading at the bottom of the channel. It's looking quite dangerous. If you want to long this, it's quite dangerous, especially longing from a diagonal line like this. It's not something that I'm a fan of. But again, I just want to show you this quickly, that this trade did in fact play out into my favor, and I did not get stopped out. I did have to worry about my stop. Something else to note is that when I saw this candle here, I moved my stop loss up here again. So if the market came back down, in this case it just came straight to my profit target, but again, this candle could have moved here and then immediately moved down, and I would have been stopped out. Okay, but I would have been stopped out in profits, so that's all I care about, and I would have probably made it 1% or 1.5% on this trade then. Okay, so these are some things that I look for, and they happens across most large and mid caps. when you start looking at low float, low cap coins or shit coins, there is a different dynamic to the market. It's more like trading penny stocks almost. These concepts are not, most of the things here doesn't really matter, because there is other forces behind the making of the price action. So if I would trade shit coins, me personally, I would try to look more at the fundamentals of the coin and sort of trade news, or trade sort of be more of a position trader, where I take a position trade, take a position trade in the coin based off, maybe I spot some kind of accumulation phase on the higher time frames, and I maybe take a position trade and I wait for a couple of weeks or months even, if I know that the coin has good fundamentals. But again, I don't trade shit coins at all. I don't trade penny stocks or any type of low float, low cap coin. It doesn't suit me whatsoever. I try to trade the larger caps and the middle caps out there. So again, this is just, I just wanted to show you this. I will probably make more videos in the future on these types of things. And again, there is a million other things you can look at, just because I have told you about. So here's the deal, right? Just because I've told you some of these things, for one, I have not really explained them in depth. So you should not go and trade based off what I've said, because you're going to need your own understanding here, okay? Because this video is only a showcase video. And for second, I've only showed you maybe like 10% or 20% of what's necessary. There's a lot of other things that you have to keep in mind, and even though you're not using everything, okay, you might not use everything, you know, but just having that in the back of your head is kind of important for trading. And you can't just, I know there's a lot of traders out there, what they tend to do is they think that just because they study technical analysis and they study you know, they read books, they watch videos, they go to they go to events, they go and watch webinars and stuff like that. You cannot cheat screen time. Okay? You cannot, there is no way, there's absolutely no way to read yourself. You can't read yourself to becoming a trader. You actually have to spend thousands of hours watching charts, okay? You can't just sit there and sort of, okay, I've read this book now, or I've learned this new thing, now I'm going to go and trade. I mean, there is no shortcuts to screen time. Screen time, most people, they underestimate the screen time, okay? I've probably spent, I wouldn't say 10,000 hours, but it's up there. I watch the charts every day. And I after a while you sort of know. After a while you sort of know. After a while you just know how the market is going to react, and especially if you're sticking to a few coins. Like for me personally, I've for the most part only watched Bitcoin. I'd say 80% of my screen time is just watching Bitcoin. I know Bitcoin in and out. I know how it moves. I know everything, okay? And there is a lot of niche scenarios that I haven't talked about yet, that I just know, okay? I just know. And, you know, you can't cheat screen time. So if you want to be a trader, there is no other way around it, okay? And for me personally, I'm an extremely introverted person, so I kind of benefit from that. And if you're as well an introverted person, I think it's gonna be hard for you to be a day trader if you're a extroverted person, because you need energy from other people to be happy and function, whilst for an introverted person it's a lot easier to sort of do these more daunting repetitive tasks, okay? So I just want to show you this trade, show you that it did play out, and I will make more videos in the future that's similar to this. And I've only showed some of the things here. I could probably spend the whole video just talking about the Ichimoku cloud, for an example, because I love the indicator. It's one of the best indicators out there.
Okay, so thanks for watching, and if you've spent, if you're here with me now, I appreciate you taking your time out of the day to just watch this video through the end. And yeah, that's that, and thanks for watching.